A very good evening, friends. So I hope you're all doing well. And I guess I should not ask the obvious question, which I've been asking for the last so many classes, because today what we're going to do is not really much connected with what you've done in the previous classes on financial instruments, because we're going to discuss some special issues relating to financial instruments. The three areas what we're left with in terms of financial instrument. One is the concept of hedge accounting. Then there is another concept which is with reference to embedded derivatives and the concept of impairment of financial assets. So as I said in the last class that I would, first prefer to do a little technical discussion so that it gets spread over in the last two classes. So what I've decided that today we're going to give a little exposure in terms of hedge accounting, because this is one area which people do face a lot of problems, and considering that conceptually you don't get clear with this area, so I thought let's begin the discussion with hedge accounting. And for that purpose, of course, we need to know the derivative accounting as well. Now, derivative accounting would become a base in terms of two things. One is understanding the accounting for embedded derivative in terms of hybrid contracts, and also in terms of understanding hedge accounting. So what I'm going to do, I've already explained you the concept of what is a derivative, but we'll still take a quick recap on our discussions that what exactly is a derivative contract. And then we'll see purely questions on a derivative accounting. We'll see how the accounting of derivative is done. Then we'll go to the next area of discussion and we'll do a little extensive discussion on the concept of hedge accounting. Thereafter, if the time permits, we'll start with the concept of impairment of financial assets. And I'm pretty sure it will not get completed maybe. So there would be a little carryover of impairment in terms of the next class. And next class, of course, we're going to discuss in detail the concept of embedded derivative. And if the time permits, I've got some more agendas to cover. But I think that's the agenda for the day. So let's begin with, first of all, derivative accounting. And then we go on to the concept of hedge accounting. And I'm sure everybody of you must be learning hedge accounting for the first time. Okay, so let's see if there are any questions to begin with. Otherwise, we're ready to start the journey. Good evening once again to all of you. And I think let's begin the journey. Okay, so first of all, let's, I think, take a little quick recap in terms of what are derivatives. So we've already covered the concept. I'm just taking a quick recap on the concept. Now, when we look at the concept of derivatives, we've already said in terms of Ind AS 109 that derivative is something which derives its value from an underlying asset. And we said that for a particular instrument or for a particular contract to be called as a derivative, there are a total of three features which we need to meet. And if any one of these features is not met, it is not considered to be a derivative. So in this particular case, let's rewind what were the features in order to prove that this is a derivative. And you need to prove all the features in this. Number one, when you say that a particular instrument or a contract is a derivative, we need to prove that it derives its value. It derives its value from an underlying asset. It derives its value from an underlying asset. So this is one feature. And if you recall, we also did one of the concepts of taking a share warrant, for example. And we said that as far as a share warrant is concerned, it derives its value from the underlying price of the shares in the market. So any instrument which does not have an independent value, but it is supposed to be deriving its value from an underlying asset, is got a feature number one. The second feature we decided was that at the time of inception, that is initially, we can say initially, there will be either a zero investment, or you can say even if the investment is there, it is negligible in amount. So it is either a zero investment or it is a negligible investment at time zero. So any kind of instrument or any kind of a contract which you call as a derivative is got a very small initial investment. Like for example, when a company would enter into an option contract, then as a holder of the option, you might pay a premium in order to enter the contract, but the amount of premium is quite small as compared to the entire contract value. So that option premium gives you a right to buy or it gives you a right to sell, and the amount could be negligible, if not zero. The second is that as far as the settlement of these instruments or contracts are concerned, the settlement always takes place at a future date. So the settlement of any derivative contract is always going to take place at a future date. And to remind you, we very clearly said that if you want to call it as a derivative instruments, you need to fulfill all the three features. So the moment you go to look at a contract or an instrument for that matter to be called as a derivative, you will first of all see that it derives its value from an underlying asset. At the inception, at the initial, the negligible investments are there, and the settlement is made at a future date. And I think if I rightly remember, I give you an inputs in terms of options and in terms of forward contract. I hope, friends, I don't need to give you any recap in terms of options or in terms of forward contracts. So do let me know if I'm supposed to give you any recap on that, or can I safely presume that a previous discussions was good enough to go. So in terms of derivative, let's also remind you that there were various kinds of examples. The most common kind of examples as far as a derivative contracts are concerned, it could be a case of a forward contract, it could be a case of a futures contract, or it could be a case of options, though there are a variety of instruments which are derivative in nature. But if you look at the most common examples, we can say it is a forward contract. We can say it is supposed to be a futures contract. And we've also got options contract, which can be supposed to be a long call and a long put. It could be a call option or it could be a put option with the related terminologies that it is in money or is it at money or is it out of money, and whether it is deeply in or deeply out of money, which we had the discussions earlier. So I guess didn't get any inputs on that. So I presume that you remember the entire inputs on the concept of what is an option, what is a forward contract, etc. Okay. So now, having taken a recap in terms of the derivative features and the common examples in terms of derivative, now let's focus in terms of accounting. So my focus now is in terms of understanding the accounting of derivative. Well, the standard is very clear on the agenda that if you're looking at accounting for derivative, we always say that it is based on an M to M basis that is called a mark-to-market margin. Put it in a simple words, we can say derivatives are accounted using what we call an FVTPL approach. That means I would consider the fair value of the option and any changes in the fair value of the options, any change in fair value of the forwards or the futures contract is going to be measured in the P&L. So whether it's an increase, a gain, or it's a decrease, a loss, whatever, you will park that in the profit and loss account. So the accounting follows the concept of FBTPL. So any increase or any decrease in terms of the fair value is going to be captured in the profit and loss section. So I think now let's have a look at an example. I'm going to take a few examples of my own, some good examples with which you can understand the derivative accounting. Because this derivative accounting is going to be very helpful, especially when I'm going to go to the concept of hedge accounting. Your understanding on a derivative accounting is going to be very helpful indeed. So let me do one thing. I'm going to share a small little question of my own to give you the accounting for a derivative. So let's take an example. Let's consider an example for understanding the derivative accounting. Now, I'm going to consider an example where I'm going to show you a variety of permutations combination, typically two, because we know that when we enter into a derivative market, you could either go in for a physical settlement, that is called a delivery settlement, or you could go in for what we call a net cash settlement. So I'm going to explain with an example that if the derivative is settled in cash, what is the accounting? And if the derivative is settled physically, a delivery settlement, then what happens in terms of things? So let's do one thing. Let's take an time scale in order to understand the accounting. So let me consider a time scale, and let's consider that my financial year is, let's say, starting on the 1st of October, and let's say my financial year is ending on 30th September. I know the financial year is April to March, but just for the sake of understanding, I'm taking arbitrary any date. So let's consider 1st October to 30th September, and let's consider that we entered into an option contract. So let's consider that a company entered into an option contract, and this option contract is entered on the 1st of June. So let's consider the financial year is ending, let us say on 1st June X4, 1st October X4, and this is ending on 30th September X5. And let's say we've entered into the contract on 1st June X5. Now, let's say on 1st June X5, the company entered into the contract to purchase. So the contract is supposed to be to buy, and the contract is to buy a total of 10,000 shares. So the company entered into the contract to buy a total of 10,000 shares, and this will be at the rate of 10 rupees per share. So we're going to buy these 10,000 shares at the rate of 10 rupees per share, and the contract is going to expire, let us say, on 1st of November X5. So let's take a little dotted line, because this is getting extended beyond the balance sheet date. So let's say this is going to be on 1st November X5. So the option contract is got a total period, you can say, starting from the 1st of June and ending as good as, you can say, 31st October. So we can say it's a period of 6, 7, 8, 9, 10. So you can say almost a period of June, July, August, September, October, 5 months. So it has got a spread over to the extent of 5 months when the contract will finish. Okay, and we're also given that there is an option premium which is paid. So the option premium which is paid at the inception, that is on the 1st of June, let's say the option premium paid is 1 rupee per share. So that's a negligible investment compared to the exercise price that you're going to buy the share at the rate of 10. Okay, wonderful. So this is the basic input which is given. I'll give you more data as we proceed. So let's, I think, begin with this part. Now, what I need to do at the very inception is that when I entered into this option contract, of course, I'm considering that I've got a long position and therefore it is a long call. So I'm making a payment of a premium. Well, this premium is going to give you a contractual right to decide whether you ultimately want to buy the shares or not. So it is undoubtedly a financial asset. So what we're going to do at the very inception, so we can say on the 1st of June, when we paid a premium, we can put the entry option debit, and we can also call it as an option premium. For understanding, let me put it in the brackets. Financial asset gets a debit and the bank or the cash gets a credit. And this entry is going to be done with the amount of premium which is paid. So we paid 1 rupee option premium on 10,000 shares. So this entry will be done with a figure of 10,000 at the inception. Simple and straight. The money which is paid at the inception, so this money which is paid at the inception creates a contractual right, and therefore a financial asset is created and the corresponding money which is paid. Now let's go further and let's see what happens on the balance sheet date. So 30th September is a balance sheet date. So what I will do, I will now consider that what is the fair value of these options on the balance sheet date, and any change in the fair value is going to be captured in the P&L. So let's give you the data. Let's say on 30th September, the premium increases to 1.3 per share. The same premium, the option premium increases to 1.3, which means You got this right by making a payment of 1 rupee per share today on 30th September. If you want to buy this right, the same option right is available at an expensive rate. So there is an increase to the extent of 0.3, which is again the value of the financial asset. The option is gone up. So what are we going to do in this particular case? We're going to put the entry option debit again. And in the brackets, let me put the financial asset. And this will be correspondingly credited to the P&L, because whatever is the change in the fair value, the change in the fair value is going to be captured in terms of the P&L. So this change from 1 to 1.3, that's 10,000 shares into 0.3. So 3,000 is the figure with which the entry is done on the balance sheet date. Simple. So I don't think so the treatment is complicated. You paid an option premium, you created a derivative financial asset. When I say the option, it is a derivative financial asset, and the changes in the fair value of the derivative financial asset is measured, rooted in the P&L. Now let's go to the date when it is a case of settlement. So this is the date when the settlement would take place, and I would say, irrespective, you are going to make a physical settlement. That means you're going to pay money and acquire the investment, or you are going to do a net settlement. Irrespective, I will first of all consider the fair value change. So let's say on the 1st of November, let's say in this particular case, the option premium increases from 1.3 and becomes, let's say, 1.5. So let's say this becomes 1.5 per share. So we can see that there is a further change in the fair value. The financial asset, which was worth 1.3 on the balance sheet date, has become 1.5. So there is another gain of 0.2 per share into 10,000 shares. So I will put the same entry, and the amount this time is going to be 2,000. 20 paisa per share into 10,000 shares. So that is the total increase. Wonderful indeed. So this is done. And let me remind you, this entry, what we are passing, is being done irrespective whether I'm going to do a delivery settlement or I'm going to do a cash settlement. Irrespective, the entry is done. Now let's watch it further. So we're going to do the further entries on the 1st of November. So let's have a look at the further entries, what we're going to pass. Now, considering that the company has got an option to delivery settle or to cash settle, let's see the entries which will happen if there is going to be, let's say, a delivery settlement. Let's say there is going to be a delivery settlement, then let's see what is the accounting entry. And let's say if there is going to be a net cash settlement, then what is going to be the entry in this particular case? I think first of all, let's understand the cash settlement, because that is very easy, and I'll give you a little crux as well. Then we go to the delivery settlement part. Now, if you look at the cash settlement, you can say the premium increased from 1 to 1.5. So there is a total increase to the extent of 0.5. So you can say an asset which is bought at 10, the premium which was paid was 10,000, and now the same amount is standing at 15. So you're going to get the money settled. So you will say that, I entered into the contract and the value of the asset has gone up. So pay me the money against the option premium. So if you settle this in cash, the entry becomes bank account debit. And the derivative financial asset, that is option, gets a credit. And this is to the extent of the balance 15, which is there in the books of accounts. As simple as that. Now, let's do a little more conceptual understanding to this particular issue. Now, watch the analysis carefully. I'm going to give you the inputs. Let's forget about the entire accounting treatment and let's understand a very simple little game. Let's understand this from a normal layman's point of view and then see what is the impact. Let's understand some basic inputs. Can I say I entered into the contract where I paid a premium of 1 rupee to buy the investment? So I made a payment of 1 rupee to buy the investment, and on the settlement date, the value of this 1 increases to 1.5. So what I understand is that I'm going to get a gain to the extent of 0.5. And if there is going to be a settlement, you can say, I paid 1 and today the worth is 1.5. Give me 50 paisa per share. So what I would understand as a layman, that I need to book that zero point 0.5 into 10,000 shares in my bank, and correspondingly it's a pure gain. So which means my net entry, should be bank account debit, and the profit and loss should get a credit. And this is to the extent of 50 paisa per share into 10,000 share. This is what I understand as a layman, that I'm making a payment of 1 rupee and it became 1.5. So I will say, okay, now there is a gain of 0.5. So my ultimate credit to the P&L should be 0.5, and the ultimate movement in the bank should also be 0.5. That's 0.5 into 10,000 shares, 5,000. Now let's have a look. Let's have a look that 1, 2, 3 and the 4 entries done. Is the net effect of all these 4 entries equal to the bank debit 5 and the option, the P&L getting a credit of 5? Let's have a look. Can I say the financial asset is 10 plus another 3 plus another 3, that makes it 15. And the financial asset is given a credit of 15, which means all the debits and credits cancel each other. So the option was a debit and a credit, gone. Let's see the other part now. The bank has got a credit of 10 and the bank has got a debit of 15. So you can see the net debit in the bank is 5. You pay 10 and the money grew to 15. And if you scare off, you get the difference of 5,000 in your pocket. And let's see the position in terms of P&L. You took a credit of 3, a credit of 2, that is 5, and the P&L gets a credit of 5. Trust me, at the end of the day, if you look at the entries periodically over a period of time, from the inception when you paid a premium to the balance sheet date and to the date of settlement, the net impact of all the entries, if you do a cash settlement, is going to be simply bank to P&L or P&L to bank, depending you're getting a gain or loss. If you're going to get a gain, the entry is bank to P&L. If you're going to get a loss, the entry is P&L to bank. Simple net impact of all the 4 entries. I hope, friends, I am pretty clear so far at this stage, right? Okay, so that is done. And Shruti, derivative is going on SFM as well in the morning class. That's wonderful indeed. Good evening, Dev. That's wonderful. So I think you're getting a good hang on things. Okay. Now let's consider that if I would go in for a delivery settlement, then what kind of entry will be done on a delivery settlement in this case? Now, if you're going to go for a delivery settlement, which means I'm going to buy the investment and the initial recognition of the investment is got to be at a fair value. Because when you recognize a financial asset, the initial recognition is always at a fair value. So let's say if I buy this shares, I will put the entry investment. This is the investment, a financial asset, which is in the equity instruments. So this is going to be a financial asset, you can say equity. So we can say the investment gets a debit, which is equity investments. And this amount is going to be recorded at a fair value. So I need to give you a fair value as well. So let's assume that I consider a fair value, let's say 11.5 per share. So in this particular case, you will record this at 11.5 into 10,000 shares. So I will record the investments at a fair value at the time of initial recognition, and the money paid gets a credit, and the money paid is the exercise price, which is 10 rupees per share. Because when I entered into the option contract, I said I'm going to pay a price of 10 rupees per share. So the financial asset, the investment gets a debit at a fair value, initial recognition, and the bank gets a credit to the extent of the amount, which is the exercise price. So this amount is supposed to be the exercise price. So now the question arises, where do we take the difference? Well, you've already created a derivative financial asset in the books of accounts, and that needs to be closed at this stage because of the delivery settlement. So the option account, which is the financial asset in the books of accounts, is standing at a figure which is to the extent of 10 plus 3 plus 2, that is 5,000. And this will take care of the entry. So this becomes 1 lakh 5. Sorry, it's standing at 15, I'm afraid, not 5, 15. So you can see the bank is 1 lakh plus another 15, 1 lakh 15, and the investment is also at 1 lakh 15. So delivery settlement is done. By the way, let me also say something more in terms of a delivery settlement as well. If I think like a layman, and I would say that, okay, I just understand one thing in life, that I paid a premium and I bought an asset. So if I paid a premium and I bought an asset, effectively, you can say I paid 11 rupees and all. So I can say that my investment should stand in the books of accounts. My investment should stand in the books of accounts at the money which I am supposed to pay, which is, let's say, 10 rupee. And the money which I'm going to pay is going to get a credit to the extent of 10,000 into 10. This is what I will think like a layman, that I will debit the investment to the money which I paid, and I'm also going to give a credit to the bank which is to the extent of 10. But the problem is that in the end is we're not going to record the investment at the money which we paid, but we need to record it at a fair value. So if you're going to record this at a fair value, so we will say this is to be recorded at 11.5. And along with this, you also paid a premium, which is 1 rupee. You also paid a premium, which is 1 rupee. So the investment gets recorded at the fair value, 11.5. The money which is paid is, you can say, 10 exercise price, and 1 rupee is the premium which is paid. Still, there is a difference to the extent of 5,000 which is appearing. And this difference is going to be, you can say, going to enter in the P&L. So that becomes 1 lakh 15. This becomes 1 lakh 10. So we're getting a difference to the extent of 5,000 which is there. Let's have a look now in this particular case. If you look at the combined effect of the entries, maybe you should be able to match up with this entry. But this is only for your understanding point of view. In the examination, of course, you're not going to show this entry. This entry is nowhere to be reflected. This is only for your cross check, that are you getting the net effects on this levels or not. You need to pass separate entries altogether. Neither you are going to pass this entry as well. This is only for your understanding perspective. So moral of the story, what I'm understanding out of derivative accounting is that when you pay a premium, you create a financial asset, derivative financial asset option account, and you pay the money. Then on the balance sheet date, fair value changes are captured in the P&L. Then on the settlement date, fair value changes are again captured in the P&L, irrespective whether it is going to be delivery settled or it is going to be cash settled. So you pay the premium, you capture the fair value changes on the balance sheet date and on the settlement date. And depending upon the fact whether it is delivery settled, if you delivery settle, you record the asset at a fair value. You pay the money equal to the excise price, and the derivative financial asset will be knocked off at this stage. And if it is supposed to be a cash settlement, then the entry is going to be simply settling the money, the financial asset which is in the books of accounts, 15,000, you get money against it. Right? I hope, friends, I am pretty clear on the derivative accounting at FPTPL, I believe. Okay, so far so good. Do let me know if this is pretty much clear indeed. Okay, so this is one. I think we can take a little variation as well. What is coming to my mind is a little more comprehensive situation, wherein I need to now understand, because this was one style, and since you're doing derivative, I think I'm a little more inclined in terms of asking a few more questions as well. Shall I do the honors of, taking a little more advanced question as compared to this one? Yes, sir. So let's take another question with you to get a little more hang on the derivative accounting. So let's take another example with you. So this was example number 1, and let's take another example number 2. I'll put this numbering as well. This is example 2, and this is my example 1. So let's give you more data, and let's see more permutation combinations coming in. Now let's consider a time scale. Let's again consider a time scale and give you some data to see the accounting in terms of these options. Now, let's say a company is got a financial year ending December. So you got the financial year January XX and it's ending on December XX, the financial year January to December. And let us say in this case, we entered into an option contract on the 1st January itself. And this was a total of 100 options. So we entered into a total of 100 options. And in this particular case, it is a premium which is 5 rupees per option. That is the premium which is paid. So on the 1st of January, we entered into an option and we are buying options. If you're buying options, that means it is supposed to be a call option and I'm paying a premium. So that is supposed to be, you can say, a long call. Okay, then it says in this particular case, let's say each share, each option will give you a right to buy one share. So we can say each option, let's say each option will give us a right to buy one share. So let's say we are going to get one option gives you a right to buy one share. For every one option, you can buy one share. And let's say at the rate of 10 rupees per share. And in this particular case, let's say the settlement date of this option is, let's say, 31st December. So it's a period of 12 months you have entered into the contract. So the option contract is entered today and it has got a 12-month span. So this is the right to buy one share on, you can say, 31st December XX. Okay, I think the data is pretty clear. So I've given you the inputs on my example. A company bought a total of 100 options at the rate of 5. That's the premium paid, which entitles you that for every one option you get the right to buy one share at the rate of 10 rupee per share. Okay, now I want to take a lot of permutations, combinations in terms of understanding these inputs. So let's do one thing. Let's give you a total of 3 permutations combination. And if there is any question which comes to your mind, ask me. Otherwise, I am ready to put a question to you after I have done. So let's begin with the 3 permutation combination. Now, let's say I'm looking at a combination number A. Let's say I'm looking at a combination number A, and the combination number A is the options are sold. In this case, I'm considering the options are sold. The options are sold, and these options are sold, let us say on 1st July XX. The options are sold on 1st July XX, and that's say at the rate of 15 rupees each. So the options are sold at the rate of 15 rupees each. Now you would see something interesting. And I'm sure you're going to ask me a question as well. I think I'm going to remain silent unless you put a question to me. So what I have done on the 1st of July XX, the options are being sold at the rate of 15. So the question now arises, what is the entry I'm going to do when you sell these options on this date? So I think let's begin the journey. Let's, I think, take you to a separate chart and let's see the accounting treatments in all these 3 cases so that we can have a look at a comparative inputs, what is happening in each of these cases. So I'm looking at the case number A. I'm looking at the case number A. So let's see the entries in a sequential order that what is going to happen on each and every date. So there are 2 focus points. One is the initial recognition. So we can say on 1st of January XX, we paid a premium. So we can say on 1st of January XX, when I paid a premium, I will put the entry option gets a debit, which is a derivative financial asset, and the bank gets a credit. And this is going to be with the amount of premium which I paid. So I paid a premium in this particular case, which is 100 options at the rate of 5. So we're going to pay a total of 500 on this particular date. So I made a payment of premium and this is done. Now, irrespective, you're going to do a physical or a net settlement. I'm going to first of all take care of the fair value changes. So if I go back, then we can see on 1st July, the premium which was 5 has become 15 per share. So there is an increase to the extent of 10 rupee. So what we do in this particular case, on the 1st of July X6, I will first of all put the entry option gets a debit and the P&L gets a credit, and the fair value changes are going to be captured in this particular case. From 5 to 15, there is a change of 10 into a total of 100 options. So this becomes 1,000. So this becomes 1,000. So this is the difference we are considering, that 15 minus 5 into 100 options. So that is the fair value change. Now, since I sold the options, it is going to be a cash settlement. And if it is a cash settlement, let's also put an entry for the cash settlement as well. So this is a case where we're doing, rather, I think, let me put it out here, that this case is supposed to be a case of cash settlement. So this is one permutation combination that you are doing a cash settlement. So whatever is the amount of option in the books, you receive money against that. So we put the entry that is bank account debit, which is to the extent of 1,500, and the option gets a credit, and the option in the books is also 1,500. So this is the settlement done. The fair value changes incorporated, and then the settlement is done. That is option 1. Let me see if there is any questions coming at your side so far. Okay, I guess somebody. So I've been watching your recorded lectures, and I must say your teaching style is exceptional. Thank you so much indeed. You make the task of learning difficult concepts much easier. You're an excellent teacher. Regard. Thank you so much, Sambhavi. That's really a pleasure. I think that's so sweet of you to come and give me that inputs. Thank you so much indeed. That makes my day, and that pushes me to do a lot of things further as well. Thank you so much. Okay, Dave says cost of assets recorded in the book. Cost of assets means book value. No. I think, Dave, you need to appreciate that investments are not recorded at cost. The investments are recorded at a fair value. We are looking at financial instruments where the initial recognition is always done at a fair value. Okay, I think I didn't get any question which I was expecting further on this. There is no further question coming in, but I had a question. I think since you didn't raise a question, let me put that question to you and you can help me out. My question now is, in this particular case, you entered into the option contract and you entered into the contract which has got a 12 months expiry. But I am settling this particular contract before the maturity date, that is on 1st of July. Is that possible? That the contract is for a period of 12 months and you doing a settlement before the maturity date? Or yes? Can I say there are two kinds of options which are entered into, what is called an American style and what is called a European style. In terms of European style, the options can be settled only on maturity. But in terms of the American style, the options can be settled at any time before maturity. I hope you got that point in your mind. Do let me know. Because when I gave this date that the options are settled on the 1st of July, what was going at the back of my mind was also that in this case, you are doing a settlement before the maturity date. So it is called an American style of settlement. Do let me know if this came to your minds or not. I would be keenly looking at that. Yes, I think Tariq gave me the answer on that. That's wonderful indeed. Great. You gave the answer wonderful. It's an American style. Superb. Now let's go to the second case with you. And in the second case, in this case, let's say on December X6. Let us say on December X6. I am given that December X6, the share price becomes 8 rupees per share. The price becomes 8 rupees per share in the market. Now the question arises, it is a long call. And if it is supposed to be a long call, are you going to exercise the option in this case? You said, I'm going to buy at the rate of 10, and if it is available in the market at 8, can I say it is supposed to be out of money? And if it is out of money, considering that we've got an option to decide to buy or not, the options in this case with lapse, it'll go unexercised. So I think we can go to the second one. And in the second one, we can say it is a case where the option is not exercised. Where the option is not exercised. Because there can be two cases One is that the option is not exercised. One is the option is exercised and it is physically settled, delivery settled, or it is cash settled. So in this particular case, this entry, of course, would remain the same. I made a payment of the premium and this entry remains the same. Now the focus of the entry is on December XX. Can I say in this particular case now, I'm not going to consider any fair value changes. In this particular case, if the option lapses, the only thing which I need to do is the premium paid is lost. So what I'll do, I'll put the entry profit and loss gets a debit and the option gets a credit. So the entire derivative in the books, which is standing at 500, is going to be expired. It goes unexercised. So you suffer a loss to the extent of 500. The premium paid is gone. Great. Now let's have a look at the case C, but I think I can make a prediction what I'm going to consider the case number C. If this is cash settled, then I think this should be a case of a delivery settle. This should be a case of a delivery settlement in this particular case. So all the permutation combinations will get taken care. So we can say if it is not exercised, B. If it is exercised and cash settled, A. If it is exercised and it is delivery settled, then C. All permutation combinations get taken care. So let's go to the case number C, where we are considering, let's say on December XX. Let us say on December XX, and we exercise the option and the price of the share is, let's say, become 25. The price of the share is become 25, so naturally we'll definitely exercise. And let's also consider that this investment which you are acquiring passes the HFT test, that is held for trading test as well. Since you're going to buy these shares, this is again going to be an equity investment, and if it passes the HFT test, then this investment will also be accounted at FPTPL. The derivative is being accounted under FPTPL, and even the investment which you want to acquire, since it passes the held for trading test, it is also going to be measured at the FPTPL itself. So let's have a look now. Let's see the entry. Can I say, first of all, these entries would, of course, remain the same. You made a payment of a premium, so this entry undoubtedly remains the same. As I said earlier in the previous example as well, that irrespective you are going to do a physical settlement or a cash settlement, you must go in for a fair value change of the derivative. So we can say that if I consider the fair value changes, unfortunately, I think I am not given the fair value changes on December. I'm not given any fair value changes on December, so let it be. So if I'm not given the fair value changes, let's directly go for the entry of investment. So on December X6, you put the entry investment. In the brackets, I'm saying FA equity investments. So since you are going to buy the investment, it would be initially recorded at a fair value, and the fair value of the share is 25 per share. So in this particular case, the investment gets recorded at the fair value. So considering that you're going to buy a total of 100 shares at the market price, which is 25, so this is going to be 2,500. But the money which you're going to pay, the money which is going to be given a credit in the bank is the exercise price. And we're going to pay an exercise price at the rate of 10 rupees per share. So you're going to buy 100 shares at the rate of 10. So that becomes 1,000. And we can say that there is already an option, a derivative financial asset in the books of accounts. So that option, that is a derivative, is going to be given a credit. So you'll square off by a physical settlement, and that is 500. So there is still a gain, and that gain is going to be taken in the P&L, which would reflect the fair value changes in terms of the derivative option. So this works out, I guess, a total difference of another, this is 1,500, 1,000. So there is a balancing figure 1,000, and this is going to be taken in the profit and loss account. I guess if we were given what was the fair value of the options, we would have already taken a fair value change. We could have done the entry option to P&L, which is to the extent of 1,000, so that it becomes 1,500. And then in this entry, it could have been investment debit, bank credit, options, given a credit to the extent of 1,500. So this is a comprehensive example in terms of understanding the derivative accounting. I have given you the features in terms of derivative. I've given you accounting in terms of derivative. Typically, I've given you inputs on options. One could even see questions as far as forward contracts are concerned, but I preferred an option because option would give you varieties of permutation combination. A forward contract does not give you an option to exit. You have to make a settlement. But option contract gives you a decision whether you want to exercise or not. So we covered if you don't exercise, if you exercise, did we settle? If you don't exercise and it is cash settle, all the combinations done. Right, friends. So I think this takes care of my derivative accounting on this. Okay, and Shruti sir, yes sir, we have studied this in recent AFM lectures. Great. And yes, at any time before expiry, we can do it. Wonderful indeed. And I think Satish also tells me you are just rewinding SFM concepts. That's brilliant indeed. Okay, that's super. So my derivative accounting is now taken care. With this, now I'm going to take you to the concept of hedge accounting. So let's now enter the concept of hedge accounting. I'm sure hedge accounting is something which is going to be absolutely new to everybody, I guess. I think if I ask you, I don't think so you would have done hedge accounting specifically in terms of AFM. So the first question is, do you know exactly what is a hedge? Maybe yes, maybe not, but I'm going to explain things from the very basic levels as far as hedge is concerned. So let's now understand the concept of a hedge accounting. I'm going to explain in very simple chronological order so that you are able to get a complete grasp on hedge accounting. There was a practical illustration which came in the RTP, and I think in order to crack that particular question, I'm going to create enough base that even if you go to get a question, maybe a little more than that level, you will be able to easily do it. So trust me, if you spend good time in terms of understanding hedge accounting, you are going to definitely understand hedge accounting because I'm going to take a couple of examples and make you absolutely clear on the concept of hedge. Now, let's begin the journey. Number one, when you apply a hedge, it is completely optional on the part of the company. It is completely optional on the part of the company. I may choose to apply a hedge accounting. I may choose not to apply hedge accounting. Now, the very first question what comes to the mind is, what is hedge? So let me tell you, because many people have got a misconception. When you tell people that what is hedge, the simple question answer comes to the mind is that you want to protect yourself against a loss. Well, I would say hedge accounting is not necessarily in terms of protecting against losses. It is also protecting your unrealized gains. So when I'm looking in terms of hedge accounting, the company can have an objective. When you're looking in terms of hedge accounting, the company can have an objective. That is, we want to basically, you can say, protect against losses. You want to protect yourself against any losses in the future. But it can also be that you want to keep your unrealized gains. You want to keep your unrealized gains intact. So the objective can also be to keep unrealized gains intact. So this is one thing which we need to consider in mind, that it is not only to protect against mishappening, but it is also that you want to keep your unrealized gains intact. I know that I've got an investment and the fair value is up. So I know that I've earned some gain on that investment, but I'm yet to sell the investment. So there is an unrealized gain. And I want to basically ensure that whatever unrealized gains I've earned on that particular investment, I want to keep it intact. I want to protect that. So it could be protections against losses, or it could be keeping the gains intact. So this is, you can say, the objective, the purpose as far as hedging is concerned. Now, let me also tell you another thing as well with a very basic example, which I always tell people. If somebody tells me what is hedge accounting, I would say very simple. Let's say it's raining outside. Now, if it is raining outside, what will I do? I'll take an umbrella. So what am I trying to do? I'm trying to protect myself against getting drenched. So that is the purpose, that I want to protect myself that I don't get drenched. So what is the tool which I use for the purpose of protection is supposed to be an umbrella. So when you do a hedge accounting, there are definitely two things. One is something which you want to protect. In my example, I want to protect myself against getting drenched. So technically, I would say it's a hedged item. So the target which you want to protect is called a hedged item, and the tool which you use to protect, that is umbrella, is called a hedging instrument. So in a practical life situation, when you're looking at a hedge accounting, the idea is you need to identify what do you want to protect, or what is the item where you want to keep the gains intact. That is called a hedged item. And you also need to understand that there is some tool with the help of which you're going to do the protection, and that is called a hedging instrument. But let me also tell you one thing at this stage. If I go in the rain outside with an umbrella, do you think I'm not going to drench? Well, the possible answers is maybe yes, maybe no. Because if it is raining very heavily, even though I'm going to take an umbrella, there is no certainty that I'm not going to drench. So similarly, when a company uses a hedging contract, there is no surety that you will be able to protect yourself completely. Hedging can help you to mitigate the risk. You can say to reduce the risk, but it does not eliminate the risk. So another thing which you need to keep in mind is when a company enters into a hedging contract, in this particular case, it will help you to reduce, or what we technically call, it can mitigate. Mitigate is reduction, to mitigate the risk. But in any case, it does not eliminate risk. So you can say it does not eliminate risk. It does not eliminate a risk. So I think I've given you two, three inputs at this particular stage. I've given you, first of all, that as far as a hedge accounting is concerned, it is completely optional. And the purpose of the hedge is that you want to protect against losses, or you want to keep your unrealized gains intact. And therefore, you could use hedged item which you want to protect, and a hedging instrument, the tool with which you will protect. And in this particular case, you will never be able to eliminate risk. You will only be able to reduce the level of risk, because even if you enter into hedge, it is not a case of a situation where you will eliminate the entire risk. Okay, this is one input as far as hedging is concerned. Now, the concept of hedging is slightly complicated. So what I've done, I've divided this into a step-by-step approach. Don't worry, this time it's not a three-step model. It is going to be a five-step model. Though I could have converted this, on a three-step model also, but I thought, let's keep it on a five-step model only. So in this particular case now, if a company goes for hedge accounting, there is going to be a five-step model. So let's have a look at the five-step model which we're going to follow in terms of hedge accounting. So when a company goes in for hedge accounting, so we're going to first of all look at the five steps in the same sequential order. Now, let's have a look at this step. The step number one is the standard says that you need to identify. The standard says that you need to identify what we call a hedged item. You need to identify what is called a hedged item. I think I've already given you that a hedged item is something what you need to protect. So you need to identify what does the company want to protect. You're trying to protect this particular X item against losses, or this item X against the gains want to be kept intact. So we will identify the hedged item, and the standard says the hedged item can be either a recognized asset or liability in the balance sheet, or it can also be an unrecognized asset or liability in the balance sheet. So it could be a case where it is either recognized or it is unrecognized in the balance sheet. Let's give you some examples. What can be an unrecognized asset or liability? Now, there are two kinds of transactions which are considered to be unrecognized in nature. One is what we call a firm commitment. One is what we call a firm commitment. So, for example, an entity is already entered into a contract, let us say to buy a machine in the future. So I'm already committed. It's a firm commitment already done. So I'm standing today and I've entered into a commitment to buy a machine 6 months later, and this is going to be bought in a foreign currency. So I know that since this is going to be bought in a foreign currency, my outflows in a functional currencies might increase. So I am fearing the risk that I'll have to shell out more money in terms of buying this machinery. So the machinery is not in the balance sheet, but I know that this transaction is bound to take place. So I can even hedge a particular contract which is not even a recognized asset in the balance sheet. The machinery is not as of now in my balance sheet of the company, but I can try to protect it as well. Because I know that adverse changes in the exchange rates would mean that there is going to be huge outflow as well. The second is that the transaction is got high probability. So you can say there is a high probability of the transaction happening. It is highly probable in nature, which means I have not entered into a contract. Let's look at a distinction between a firm commitment and a highly probable transaction. If you say that the chances of this transaction occurring is quite likely, it is highly probable, though I have not entered into any firm commitment to buy that particular machine. But I know that there is a huge probability, it's a highly forecasted transaction, that yes, it will occur. So again, in this case, the asset or liability is not in the balance sheet of the company. So the standard says, no worry, when you're looking at a hedged item, it doesn't make a difference whether what you want to protect is a part of your balance sheet or it is not yet a part of the balance sheet, but it is something which is a firm commitment, which you have already entered into, or maybe not entered into, but it is highly likely because it is a highly probable forecasted transaction which is bound to occur. Then comes the step number 2. Once you have done this, you go to the step number 2. And in terms of the step number 2, we now need to identify the hedging instrument. So what do we need to do in this particular case? We need to go for identification of what we call a hedging instrument. Now, as far as a hedging instrument is concerned, the standard says that when you're looking at a hedging instrument, generally, I'm saying generally, a company would use derivatives for the purpose of hedge accounting. If you want to protect something, the protection generally, the tool which is going to use the umbrella in my example to protect is going to be derivative. So option contract, futures contract, forwards contract, interest rate swaps, the list can be endless, but generally what we will use in this particular case, generally what you're going to use in this particular case is derivatives. That is the reason I gave you the accounting in terms of derivative at the inception. So if the company is looking at the tool which will be used to protect the hedge item, it is generally going to be a derivative instrument. Okay. Now at this stage, I think before I take you to the further steps, I think I need to give you a little more exposure, which I'm sure you would be knowing it with your knowledge on AFM. But just to be on a very safe side, for those who might be looking at and may not have done AFM, or maybe they want to get a little more clarity. So let's do one thing. Before I go to the step number 3, I want to first of all give you a basic picture in terms of hedge accounting at this very stage itself. Let's consider a small example before we go further, that why are we considering the hedging instrument that is a derivative for the purpose of protection. So let's consider this. Now this is, let's say, your share market. Let's say this is your actual share market where a delivery settlement will take place. And let's say this is your derivative market. Now, let's say this is your derivative market, and let's understand the complete procedure, how this hedging on a very basic level would take place. Now, let's consider that my company in the share market made a purchase. So I purchased, let us say I purchased a total of 1,000 shares. Or let's not take shares. I think I'll take something else. Let's say I purchased an investment. or even if you take it shares, that's okay as of now, because later it might create a confusion. So let it be shares. So let's say I purchased a total of 1,000 shares, and let's say this is purchased at the rate of 120 per share. So in the share market, I made an investment and I purchased 1,000 shares at the rate of 120, which means if I look at my portfolio value is supposed to be 1.2 lakhs today. The day I made the purchase of the investment, my portfolio value is supposed to be 1.2 lakh. Now, let's say I am fearing that this investment value will go down. I fear that the prices in the share market will come down and I will lose the value of my portfolio. So what I can do in this particular case, in order to protect myself, I do one thing. I correspondingly enter into a derivative market and I say, okay, let me enter into the contract to sell these 1,000 shares. And let us say I am able to enter the contract exactly at 120. Let me tell you one thing. Let me tell you one thing, that it is not necessary that the price in this market would also be 120, because this market is going to derive its value from this particular market. And if it is going to derive its value from this market, it is not necessary that it would be same. I hope you remember the example of that PVR ticket as well as a PVR pass. So this is going to derive its value from this market, so need not necessarily be same, but I am intentionally keeping it same. So the company entered into a derivative contract and let's say they sold 1,000 shares. They entered into a futures contract, for example, where they said we're going to sell these shares at the rate of 120. Now, as was anticipated, the price of the share in this market actually fell down and let's say it became 90 per share. I was anticipating a fall and let's say the price of the share actually went down and the price became 90. If the price became 90, then what is my portfolio value now? Can I say the portfolio value has become 90,000? So in this market, I have suffered a loss to the extent of 30. Because of the prices going down, I'm suffering a loss to the extent of 30,000 in this particular market. Now, one thing is very clear, that if the prices in the share market went down, do you think the prices in the derivative market will also fall down? 100% yes. Let me make it very clear that the direction is going to be same. If the price in this market goes up, the price in this market goes up. If the price in this market goes down, so would the price in this market go down, because ultimately the derivative market is deriving its value from the main market itself. Well, that is another thing, that the fall in the price may not be equal to the fall in the price in this market. So there is a possibility that if there is a fall to the extent of 30 in this market, there will be a fall, but the fall may not be exactly 30. But I think to make my things easy, let me consider that the value in this market is also 90. Let me consider for convenience and understanding that let's say the absolute fall in this case is also 90. But one thing I can definitely say, that the movement will always be in the same direction. So one thing which I can 100% vouch you, and you will agree as well, that the movements in this case will always be a same direction for sure. So you can say that in this market, if the price is declining, this will decline, but the absolute change could be different. So the absolute change can be different. The absolute change can be different. So direction would be same, but as far as the absolute movements are concerned, it may not be same, but I am intentionally keeping the movements to be same. So in this particular case, now let me see if I do a cash settlement. If I do a cash settlement, you might be aware the concept of what we call squaring off in a derivative market. That when you do a cash settlement, we do the concept of what we technically call a squaring off. What does a squaring off mean? A squaring off means that if you sold, now to square off, you will buy. And if you said, I buy, in order to square off, you would say sell. So you need to calculate a gain or loss by squaring of the transaction, saying that if I sell, then to square off, I'll buy at 90. So if you want to square off the transaction, if you want to square off the transaction, so I will take a opposite action and I will say, okay, I buy at 90, then I sell at 120. So if you buy at 90 and sell at 120, you're going to get a gain of 30,000 in this particular market. 30 into a total of 1,000 shares, a gain of 30. Wow. You can now clearly see one thing very prominent, that there is a loss in this market and there is a gain in this market, which intentionally I've taken the same. So you can see by entering into a derivative market, what I've done, the loss in the share market is being covered up by the gain in the derivative market, and my wealth position is intact. Because you've got 90,000 is the portfolio value and you've got a gain of 30,000 in the derivative market. So your portfolio value is going to be intact at this particular stage. This was an example of a perfect hedge. But it may not always be a perfect hedge and the gain loss may not be same. But one thing is very clear, a loss here would mean a gain here, a gain here would mean a loss here, but the absolute figures could different. But one thing is undoubtful, gain, loss, gain for sure. Right, I hope I made myself very clear on this. And can I say this is the share which I can call it as a hedged item? This is a share which I can say is a hedged item, and what you've entered into the derivative market is supposed to be a hedging instrument. And what you've entered into the derivative market is supposed to be a hedging instrument. Right, friends? I hope I made myself clear. I'm just trying to give you the concepts related to the FM, what I need out here. Okay, and I think I'm getting some lot of inputs as well. Okay, Shruti, can you kindly compare E and C last entry, please? Okay, we'll come back to that later. And I think I'm getting, Sumit tells me hedge means taking a contrary position, correct? And Mancha, default risk is always remains. And okay, Prashant says, can you explain the highly probable transactions? Okay, and Sumit says, is squaring off and hedging same? No, it is not. I'll explain the highly probable transaction as well. Let me take a little recap on the things with you. Let's go back and take a little recap on these things with you. So what we are saying that in terms of hedge accounting, I intentionally didn't look at the questions in between because the flow of sequence is a bit technical. So I thought, let me first finish with my flow and then I'll take the inputs as well. So let me answer the one or two pending questions which are there before we take the journey forward. Now, the first thing which I said is, when the company enters into a hedge accounting, the idea is one of the two. You want to protect yourself against losses happening, or you know that there is a gain which has occurred, but it is not realized, it is unrealized gain, and you want to keep that money intact. So the company enters into hedging with the perception that you want to safeguard yourself against any losses happening, or you want to basically keep your unrealized gains intact in nature. So with this, I gave you two steps. Identify what you want to protect, and that is called a hedged item. Now, when I said a hedged item, you can protect something which is already in the balance sheet, or you can protect something which is not yet in the balance sheet. It can be a recognized asset liability. For example, you've got a debt investments. For example, you've got a equity investments. For example, you've got an inventory. For example, any asset or liability. It's not necessarily that what you're trying to protect is a financial instrument. What you're trying to protect can be a simple inventory as well. So it is something which is already in the balance sheet, or it is something which is not in the balance sheet. Now, when something is not in the balance sheet, there can be two kinds of situations. One is that you've entered into a commitment. You've already entered into the contract to buy something in the future. So this is something which is a commitment. You've already entered into the contract and you're committed to buy, let's say, a machinery in the next 6 months. And when I say that it is highly probable, I have not yet given a commitment. But I am considering that this transaction is quite highly likely to occur. So this transaction will definitely incur in the future. I've not entered into a purchase of machinery, but I know that there is quite a good chance that I will definitely buy a machinery and import it in the future. So this is that you've already entered into the contract to buy, and this is that you've not yet entered, but the chances are highly likely that you will buy a machine. So the company can go in for a protection of a firm commitment, a highly probable forecasted transactions, or a recognized asset and liability, right? I guess the first question gets answered on that. That was, I think, for Prashant. And Sumit, you said squaring off and hedging is the same. No, they're not. Well, squaring off is simply, you can say, a technique to calculate the net gain or loss. Hedging is different. So when you're looking in terms of squaring off a transaction, as I explained, that in this case, you took a position to sell. So now to square off, you're going to take an opposite position and you're going to calculate a gain or loss. So if you said, I will sell, then I'll say, okay, if I buy, what is the gain or loss? Taking an opposite position to calculate the gain or loss is called doing a squaring off. And let's say if you said, I will buy, then you will say, okay, I will sell, and you will do a squaring off. So squaring off is only to calculate the gain or loss arising on net settlement of a derivative contract. It's not hedging, right? I guess I have clarified the issues, I believe. Okay, now let's take it further. Now coming back to the picture. So we've understood the two steps, hedged item and the hedging instrument. Then comes the step number 3. Then comes the step number 3. Well, step number 3 is going to be more theoretical for us, because in a practical question, of course, we are not going to apply all these things, but practically it can be a huge lot of homework as well. The step number 3 is meeting what we call a qualifying criteria. The step number 3 is meeting what we call a qualifying criteria. You know, the standard setters were very clear that we need to be, very sure that if a company is wanting to do hedging, they wanted the company to do a formal documentation in terms of the entire hedging. Let us understand the company's perception why they want to do hedging. Are they considering the right kind of items to hedge? Are they considering the right kind of instruments to hedge? Indirectly, we say that you need to see that is the hedged item an eligible item. I'll not get into the detail because not every item can be hedged. Though I've given you, it can be recognized, unrecognized. But the step number 3 involves looking into that the items which you want to hedge, is the hedged item a part of the eligible list which can be hedged? Is the hedging instrument which you've identified, is it something which is eligible in nature? Is the company done a formal documentation of the entire process of hedging? Have you tested that the hedge effectiveness is good or not? Like in the example I gave you, I think it was a perfect hedge. And if you ask me the hedge effectiveness of this particular case, I would say it is 100%. Because you've been able to capture 100% of the loss in this market. So your hedge effectiveness is 100%. Because your loss in the share market was 30 and the gain in the derivative market is 30, you've been able to capture the full amount of loss. So the standard required that in this particular case, when the company goes in for a qualifying criteria, you need to see that are you having eligible hedged items? Are you considering eligible hedge items? And are you considering eligible hedging instruments for the purpose? So are you considering the eligible hedging instruments for the purpose or not? So the list of the hedged item is eligible. The list of the hedging instruments is eligible. Did you do a formal documentations or not? Did you do a formal documentations or not? Because this formal documentation is going to be very necessary to understand the perception of why the company wants to hedge and what kind of hedge are they planning in order to do the protection. And most importantly, we need to prove that there is hedge effectiveness. Now, we will not get into the details of these things, that what should be the level of hedge effectiveness and all, because if you're going to get a questions to do a practical we will be clearly stated, or we will presume clearly that yes, the step number 3 is met. We will always presume that yes, a formal documentation is done, the hedged item, hedging instruments are eligible, and the hedge effectiveness, everything is met. So step number 3 really doesn't bother me from an accounting perspective. Then let's go further. To the step number 4 and the step number 5. Now, in terms of the step number 4, the company needs to decide the type of hedge. So if you're doing a hedge accounting, you need to decide what is the type of hedge. Well, if you technically ask me, there are going to be 3 types of hedge. One is called, you can say, a net investment in a foreign operation. Well, I think I'm not touching that, because even I've not seen any questions on a foreign subsidiaries coming in. And if there is a question in terms of foreign subsidiaries, then it gives rise to a net investment in a foreign operation. So I'm going to explain only the 2 kinds of hedge. One is called a fair value hedge. And the other one is called a cash flow hedge. So there is a third hedge as well, but we're not getting into the third hedge. That is a NIFO, that's called a net investment in a foreign operation, but we're looking in terms of a cash flow hedge. So these are the 2 kinds of hedge. That is what we call a fair value or a cash flow hedge. Trust me, in a practical life scenario, it can be quite challenging for a company to decide that, are we using a fair value or are we using a cash flow hedge? Because in a same situation, mind the words, in a same situation, let's say one management believes that I want to protect the fair value gains and loss. And in the same situation, another management feels I want to make a protections of my cash inflows and outflow. So it is not necessary that, in a given situation, only one kind of hedge can be applied. It all depends upon the management perception. What are they trying to hedge? So this instructions, I believe, would always be given in the question. I don't need to make a decision in terms of what kind of hedge. So the management could be wanting to protect the fair value changes, then I would go for a fair value hedge. The management is wanting to protect the cash inflows and outflows. So let's take an example. Though we'll do a lot of questions with you, where you will get an idea in terms of what kind of hedge is being done. Let's say, for example, I have an investment in, let's say, equity investments. Now, if I've got investments in equity investments, I already purchased that investment. And since I've already purchased the investment, I want to protect the fair value of that investment. So I would enter into a fair value hedge. Like, for example, my company is planning to buy a machinery in the future. If I'm planning to buy a machinery in the future, then I am trying to protect the cash outflows which will take place. I know the rate of exchanges might turn adverse and there might be more outflows. So what I'm trying to protect is my cash outflow. So I would enter into a cash flow hedge. Finally, once a company decides on the type of the hedge, then comes the main agenda, and that is the accounting of these hedge. How would the accounting in terms of the fair value hedge and the cash flow hedge is going to take place? So my focus is, of course, going to be on step number 5. So when I'm going to pick up a question, I will definitely focus on step 1 and 2, identifying the item which I'm trying to protect, hedge item, the instrument with which I am protecting, there is hedging instrument. Step number 3, of course, would not take effort. Step number 4 will be given, and we're going to focus in terms of the accounting. Now, what I'm going to do, I'm going to first explain the accounting of a fair value hedge conceptually. Then we'll do some questions on fair value. Then I'm going to explain the accounting of a cash flow hedge. Then I'm going to do some questions on a cash flow. And once I'm done with the questions, you will definitely get a good hang in terms of fair value and cash flow hedge. Let's begin the journey. Let me see if there is any questions coming so far. No, I think we are all sorted. So let's begin the accounting in terms of a fair value hedge. So I'm going to first of all come to the concept of a fair value hedge. Let's understand the accounting for a fair value hedge, and then we'll do an example. Now, the accounting for a fair value hedge is pretty simple and pretty straight indeed. So I'll explain first of all conceptually. So let's put it like this, that I've got on one hand the hedged item, on one hand I've got a hedged item, and on the other hand I've got a hedging instrument. So on one hand I've got a hedged item, and on the other hand I've got a hedging instrument. So let's consider that we've got a hedged item and there is a hedging instrument. Now, the basic rule, I'm saying the basic rule, but we'll give you exceptions of that rule as well. The basic rule. So let's see what is the basic rule in terms of things. Now, please hear me very carefully. Let's say, for example, I am trying to protect my inventory. Let's say I'm trying to protect my inventory. Now, the standard which applies to inventory is going to be IND AS2. The standard which is going to apply to inventory is going to be IND AS2. What does IND AS2 says? That inventory is going to be taken at cost or NRV, whichever is less. So when you look at Indian Accounting Standard 2, it says inventory will be taken at cost or NRV, whichever is less in the books of accounts. Now, please remember one thing. The moment the hedged item comes under the purview of a fair value hedge, the relevance standard becomes irrelevant, which means now I will not apply IND AS2, but this inventory will be recorded at a fair value. The normal standards applicable to the item, so whichever item is the hedged item, I will start applying the normal accounting standard to that item. Inventory will now be measured at a fair value. Any fair value changes, increase or decrease will be captured in the P&L. We will override the provisions as far as the other relevant standard is concerned. And that is the reason the step number 3, which is a concept of qualifying criteria, is important, where a formal documentation is being done. Because if the auditor goes to the company, he needs to know that why the inventory perhaps is taken at a fair value, because it is a part of the hedge accounting. And if it is a part of the hedge accounting, the normal relevant measurement principles are getting overridden, and IND AS2 would not trigger, and you got to consider the inventory at a fair value, and any fair value changes will be captured in the FPTPL. And as far as the hedging instrument is concerned, you entered into a derivative contract. You entered into a derivative contract, and the accounting for derivative as it is at FPTPL. Now you can see, if you go back to the same example which I gave you, that there was a loss in the share market and there was a gain in a derivative market. So what will happen in this particular case? The fair value change of the inventory goes to the P&L, the fair value change of the derivative goes to the P&L, and it gives you an offsetting advantage. If a company would not have applied hedging instrument, then this would have been taken at cost or NRV, whichever is less, and this would have been taken at a fair value through P&L. So your impact on the P&Ls would have been different. So the company consciously decided that I want to protect the value changes in the inventory. So they said, let me bring it as a part of the hedge accounting. So the fair value of the inventory captured in the P&L, the fair value changes of the derivative captured in the P&L, the gain here and the loss here, or the loss here and the gain here, is going to give you an offsetting position, and which gives you a good advantage. So this is what we do in terms of fair value hedge. As you can say, generally this is done in terms of a fair value hedge. But there is an exception. And the interesting exception which comes is, if you remember, a company has got, let's say, equity investments, which is measured at FPT-OCI, that is NR. If a company has got equity investments which is measured at FPT-OCI NR, am I going to override the concept and take it at FPTPL? I cannot. The very essence of the standard is that equity investments is considered to be FPD OCI NR, which means the fair value changes goes in the OCI, the gain or loss on the sale goes to the OCI, the accumulated OCI never goes in the P&L, impairment losses not conducted. The equity investments is one thing which is protected from anything entering the P&L. You can see the fair value changes, OCI. You can see the gain or loss on investment, OCI. And you can see that when the investment is sold, the accumulated fair value changes in OCI goes directly to the tab number 2 without being recycled in the P&L. And it is protected in terms of impairment. We do not conduct any impairment testing on equity investments at FPD OCI because we don't want to put anything in the profit and loss for this investment. So the standard setters decided on an exception, and they decided an exception and this exception. And this exception is that if your hedged item is supposed to be an equity investment, which is measured at FPT OCI NR, the fair value changes will be entered in the OCI itself. So they decided in this case, the fair value changes will be taken in the other comprehensive income. And you know what? That in this case, even the fair value changes of the derivative will also be taken in the other comprehensive income. So we will take the derivative changes in the OCI, the hedged item changes in the OCI. So moral of the story. If somebody says that what is the accounting on a fair value hedge, I'll say, okay, you bring an item under the purview of fair value hedge, forget about the relevant standards and start capturing the fair value changes of the hedged item. The fair value changes of the hedged item goes in the P&L. The fair value changes of the derivative, that is hedging instrument, goes in the P&L. But the only exception where you are going to hedge an equity investments measured at OCI NR, you're going to take the fair value changes in OCI, and here also the derivative fair value changes goes in the OCI, so you get that offsetting advantage. I hope I am clear with the basics on the fair value hedge, right? And Prashant says, so what will happen if the qualifying criteria is not met? Well, if the qualifying criteria is not met, the company cannot go ahead with the hedge accounting. In order to go ahead with the hedge accounting, the auditor will not allow the company, if the qualifying criteria is not met, you cannot do hedge accounting in the company unless you meet the criteria. Right? Okay, now let's do one thing. Let's consider an example. I'm going to take a simple example and explain the concept of hedge accounting to you with a simple example. So let's take a simple example now on the concept of a fair value hedge. So this is an example which I'm considering on a fair value hedge. So let me give you a simple example of my own, and let's give you a data. So let's take a time scale, and with this we will look at the changes. Okay, let me just give you the facts. Let's consider my financial year is January to December. So let's consider my financial year is January X8, and let's say the year ending is December X8. Now let's say an entity made a purchase of equity instruments, and this is at 9 lakhs. So the company made an investment, which is equity investments, and this is made at 9 lakh. So this is the fair value at the initial recognition. You acquired the investments at a fair value itself. And let us say the company decided that it is going to be accounted at FPD OCI, that is NR, based on Ind AS 109. So we decided that this instrument is not held for trading. So the standard gives you a choice of considering FPTPL or FPT OCI, and the company decided FPT OCI, no recycling. Now let's say on 30th September, so let's say on 30th September, that is somewhere in between the year. So let's say the equity instruments is still the same, but the management started fearing that the value of this portfolio will go down. So they started having a fear that the value of this investment will fall down. So what they did in this particular case, they entered into a futures contract. So they entered into a futures contract, and this futures contract was entered on this date to sell. So the futures contract was entered to sell the shares at 9 lakhs. So we entered into a futures contract to sell the shares at 9 lakh on 30th September. Okay, let's assume all the qualifying criteria, everything is met. Now let's also give you the data on the balance sheet date. So this is the balance sheet date. Let's have a look at the status on the balance sheet date. Let's say the fair value of this equity instrument. So let's say the equity investments, the fair value on this particular date fell down to 8 lakhs. It fell down to 8 lakhs. And let's consider the futures increases. So the price of the future increases by, let's say, to the extent of 90,000. So the equity investments went down to 8 lakh, and as far as the futures price is concerned, it rises by 90,000. I now need to understand a very basic accounting of this fair value hedge. So let's begin a journey in terms of the 5-step model and apply the inputs. Now, let's go step by step and we'll see the accounting. So let's look at the step number 1. If I am asked in this question, what is the hedged item? If I'm asked in this question that what is the hedged item, I would say the equity investments is the hedged item. The management had a fear that the value of this portfolio will go down, so we can say that this is the hedged item. Then I go to the step number 2 and I say, okay, what is the hedging instrument? I go to the step number 2 and I put across a question that what is a hedging instrument? So I would say it is the futures contract which is supposed to be the hedging instrument. You are trying to protect your equity investments hedged item, and you are trying to use derivative, a futures contract that is hedging instrument. Then we go on to the step number 3. And in terms of step number 3, let's see whether a qualifying criteria is met. Let's assume a yes. So we're looking at, is the qualifying criteria met? Let's assume a yes. Let's say this is eligible hedge item, eligible hedging instruments, the hedge effectiveness is tested, formal documentation's done, etc. Then you go to the step number 4 and the management tells me that they want to enter into a fair value hedge. They tell me that they want to enter into a fair value hedge. Now finally comes the step number 5, that is accounting. So let's have a look in terms of how the accounting will be done for this particular hedge. Now the accounting is pretty simple and straight. Now watch this, it is very simple, very basic example. The next one is going to be a little more complicated, but this one is going to be pretty simple and straight indeed. Now my hedged item is supposed to be an equity investments measured at FPD OCI, which falls a part of the exception. So what is the fair value changes of this investment? From 9 lakhs, it became 8 lakhs. So we can say that there is a fall, a fair value decline of 1 lakh on this equity investments. So as a basic rule, I would take it to the P&L, but this is an exception. It will be taken in the OCI. So let's do one thing. We'll put this money in the OCI. So let's take an OCI debit, and the financial asset, that is equity investment, gets a credit, and this entry is done with 1 lakh. This entry is done with 1 lakh. The fair value changes in the equity investments taken to OCI. Now let's consider the fair value changes of the hedging instrument as well. In terms of hedging instruments, we are already given that there is an increase in the futures value. If there is an increase in the futures value, which means that I am getting a gain. As it is a loss in a share market, is going to be a gain in a derivative market. So the increase is a gain. So what I'm going to do, I will create a derivative financial asset. Let's call it as financial asset derivative. So we're going to create a derivative financial asset, and the change is going to be entered again in the OCI. So when you took the fair value change of the hedged item OCI, the fair value change of the derivative is also taken in OCI, and this is to the extent of 90,000. Am I able to hedge the entire things? No. I've been able to hedge only, you can say 90%. The fair value decline of the item is 1 lakh and the hedging instrument saved 90. So the loss here is compensated with the gain. So it is not a perfect hedge, but still the impact on the income statement at least got reduced by 90,000. That is the accounting. Simple and straight. I don't think so this question would have created any kind of thought processes. I think simple and straight, right? Okay. So this is one example on a fair value hedge. Let's, I think, take another example as well. And let's take a normal example, and then I think we can go to cash flow hedge. Let's take one more example with you to get more clarity in terms of things. Because once I'm going to take you to the cash flow hedge, more thought processes will start coming in. Because what happens when you go to learn the fair value hedge and then you go to the cash flow hedge, suddenly it'll, might create a confusions. Or what happened used to happen in a fair value hedge? What is happening in a cash flow hedge? So don't worry, I'll give you a mapping, also give you clarities towards the end, a minor mapping. So let's go to the example, another example on a fair value hedge. This time, of course, we're not going to talk in terms of OCI, but P&L. Let's say a company entered into, let me take a time scale, and let's consider my financial year is December X1. So let's take a time scale to understand the accounting. So my financial year is January and it is ending on December. Now let's say a company has a firm commitment to buy a machinery, and this is on 31st March X2. So this is X1. And let's say this is X2. Let me just slightly decrease the space. So let's consider this is December X1 and this is 31st March X2. This is 31st March X2. Okay, now let's give you the inputs. So we are given in this particular case, I am given that a company has got a firm commitment to buy. So we have already entered into a firm commitment. So you've already entered that firm commitment already. So it's an unrecognized asset. There is a firm commitment to buy. And the firm commitment is to buy, let's say, a machinery. So we're going to buy a machine, and this machine is going to be bought, let's say, to the extent of, let's say, 20 lakh. So I'm going to buy, let's say, at $20 lakh. So let's say I'm going to buy this machine to the extent of, let's say, $20 lakh. Or let's put it currency units. I think I'll keep it not this. Let's keep it as currency unit, that is 20 lakh. CU is called a currency unit. So let's say the company entered into the firm commitment already, and they know that they're going to buy this machine. So they're going to buy this machine at 20 lakh currency units on March X2. Naturally, the directors are worried about the exchange rate fluctuations. So we are also given on 1st October X1. On 1st October X1. So on 1st October X1, let's consider the rate of exchange is $1 is equal to, let's say, 2 currency units. So let's say $1 is 2 currency units in this case, and they entered into a futures contract on this date. They entered into a futures contract on this date. I'm considering my functional currency to be dollar. Let me, I think, put that ahead, because I'm considering according to the data that, let's say, my functional currency is dollar. So their functional currency is supposed to be dollars, so keep that base into account. So let's say on the 1st of October, I gave you the exchange rate, and the company enters into a future contract to buy, let us say, 2 million currency units. And this is going to be, of course, on 31st March. So the period of this contract, let's consider the period of the contract. So we can say 6 months, I guess. So you entered into the futures contract to buy 2 million currency units at a futures rate when the rate of exchange is given. Okay. And then let's say that on 31st December, now let's give you a rate of exchange on 31st December as well. And I am given, let's say this currency unit 2 million is going to cost you, let's say a total of 11 lakh dollars. So let's say on the balance sheet date, the 2 million currency unit will cost you a total of 11 lakh. And the fair value of the futures increases. The fair value of the futures, let's say, increases on this date, and let's say it increases by 95,000. So the value of the futures contract is gone up to the extent of 95,000. And this is $95,000. This is $95,000. Okay, and let's assume all of the things are in place. Now let's have a look in terms of the 5-step model. Let me just give you the data. On 1st October, the company entered into a futures contract, which is going to be, done on 31st March X2. And we are given the status on the balance sheet date, that what is the rate of exchange in terms of the currency unit and dollar, and what is the position of the fair value of the futures contract on the balance sheet date. We're not looking at post balance sheet date. Oh, sorry, this is the data on the balance sheet date. This is the data on the balance sheet date, not on this date. Right, so this is done. Now let's begin with a 5-step models out here. Let's, I think, start the journey on the 5-step model. We go to the step number 1. Now, in this particular case, if I am put across a question, what is a hedged item? I will say the firm commitment to buy the machine is the hedged item. It is an unrecognized asset in the books of accounts, but nevertheless, it is a hedged item. So we can say, if I am asked that what is a hedged item, I would say the hedged item is the firm commitment to buy the machine. That is what I am trying to protect. Then if I go to the step number 2 and I decide in this case, what is the hedging instrument? And I decide what is supposed to be the hedging instrument. And I think it is very clear that the hedging instrument is the futures contract. So the company is entering into a derivative market, a futures contract, in order to protect. That is the hedging instrument. So we go to the step number 3 and we look at, is the qualifying criteria getting met? So we'll look into and see, is the qualifying criteria getting met? Let's assume yes, the qualifying criteria is met. Eligible items of hedged item, eligible hedging instruments, formal documentations, hedge effectiveness, all the criteria assumed to be met. Then I ask the question, what kind of hedge do you want to enter? They tell me we want a fair value hedge. So now the only thing that's is the accounting. Pretty simple. Let's begin. So let's have a look now in terms of step number 5, where we're looking in terms of the accounting of this fair value hedge. Now the hedged item is not equity investment, doesn't fall in the exception. So the fair value changes of the hedged item, P&L. The fair value changes of the hedging instrument, also P&L. And if you would have noticed or not, I would like to make you notice as well. In the previous example, I intentionally took a recognized asset with the exception. And in this particular case, I've intentionally taken an example which is an unrecognized asset, of course, not an exception. Because now you would also need to consider that what kind of entry am I going to pass when I'm entering into a firm commitment and there is no machine which is there in the books of accounts. Now let's see the fair value changes of the hedged item in this case. Can I say when I was entering into a contract, when I was entering into contract, I know that this is the amount I am going to pay, 20 lakh currency units, and the rate of exchange is supposed to be 2 currency unit, $1. If it is 2 currency unit is $1, how much would be 20 lakh currency units? Can I say this is as good as, you can say, 10 lakh dollars. So we can say 20 lakh currency units according to this rate of exchange is going to be considered as 10 lakh. Now we can see that the same currency unit, 2 million currency unit, is costing 11 lakh. So in order to buy the machine in my functional currency dollar, I have to shell out 10 lakh dollars and now I need to shell out 11 lakh dollars. So there is a loss. And this loss is going to be recorded in the profit and loss. So P&L debit. The question arises, what is the corresponding credit? Open up a firm commitment account. There is no machine in this particular case, so open up a firm commitment account. So any changes in the fair value of the hedged item in this case is the firm commitment. So put this firm commitment as a ledger. And this amount is going to be recorded at 1 lakh rupees. The fair value changes of the hedged item is taken in the P&L. And as far as the futures is concerned, it's a gain. And in this particular case, even this gain is going to be taken as a derivative financial asset. So we will create a derivative financial asset for the gain. And the corresponding credit is going to be taken in the P&L, and that is to the extent of 95. The concept is absolutely same. So the change in the fair value of the hedged item went to the P&L. The change in the fair value of the hedging instrument went to the E&L. Even this is not a perfect hedge because you've been able to hedge only 95% of the amount. Because 1 lakh is the debit to the P&L and 95 is a credit. So out of the loss, you've been able to hedge 95%, and still there is a net impact of 5,000 on the profits of the company. Right? So far, so good. I hope the concept of a fair value hedge is pretty much clear, friends, at this stage. Okay, and Neha sir, Index 115 के notes upload नहीं है. Index 115 के notes. Oh, I have not taken 115. Right. Okay. I think somebody is connected to the chat who is they've got some other class. He's giving some answers to options. Okay. Anyway, so this part is done. So this takes care of the inputs in terms of the fair value hedge. Now I am going to take it further. But I think before that, we need to give you a break as well. I'm sure your mind must be tired. So before I go on to the concept of a cash flow hedge, I am going to first take you to the concept in terms of the concept. So first, let's take a break and then we begin the journey, friends, with you. Okay, so far so good. So I think it's almost 7:47. So 10, 12 minutes and I join you back and we start the journey on the cash flow hedge, friends. So enjoy your break. I'm going to join you back after the break. friends. I hope you had a relaxed mind. So we were discussing the accounting for a fair value hedge, and now I'm going to take you to the accounting as far as a cash flow hedge is concerned. Okay, so I think let's begin the deal. So I'm now going to take you to the inputs of a cash flow hedge, a little change in accounting, but a very interesting one indeed. So let's have a look at accounting for a cash flow hedge. We'll take a example as well, but let's first understand conceptually the accounting in terms of a cash flow hedge. Now, the accounting is quite similar, that you need to calculate a fair value change of the hedged item and you need to calculate the fair value change of the hedging instrument, but please watch this very carefully. So let's consider that we're looking at the hedged item. We're looking at the hedged item and we're also looking at the hedging instrument. So we're looking at the hedged item and we're also looking at the hedging instrument. Now, be careful on the words what I say. In this case, we will calculate the fair value change of the hedge item, but not account for it. So, what did you say? Well, I said, in this case, I will definitely compute. I will compute the fair value change, but it is not to be accounted. It is not going to be accounted in the books of accounts. So then why do you need to calculate the fair value change? If you're not going to account for the fair value change, what is the fun of calculating the fair value change? No worry. We're just going to compute the fair value change, but it is not accounted. Here we will compute the fair value change and it is also going to be accounted as well. Now, for ease of understanding, let's consider the fair value change of the hedge item. Let's consider this to be A. So for the ease of understanding, let's consider the fair value change is A, and let's say the fair value change in this case is B. So what do I do in terms of the first stage? I am going to first of all, in step number one, calculate the fair value change of the hedge item. And I'm also going to calculate the fair value change of the hedging instrument. Then I go to the step number two. And in terms of the step number two, what we will do, we will compare A versus B. So you're going to compare the fair value change of the hedged item and the fair value change of the hedging instrument. Now, in this particular case, when you compare A versus B, the possibilities are, rather instead of three, let's take only two possibility. So the possibilities in this case is that A is greater than equal to B, or we can say A is less than B. So there are two possibilities, that the fair value change of the hedged item is either equal or it is greater than, you can say, the fair value change of the hedging instrument. Well, if this be the case, we will record the amount which is in B. So we will record the B amount. I will record the fair value change of the hedging instrument, and this amount will be recorded entirely in the OCI. So if A is greater than or equal to B, then we will record the B amount. So we will only capture the B amount, and this amount is going to be taken in the OCI, and from the OCI, it will be captured in SOKI, and in SOKI, it will enter in tab number 3, because what enters in the other comprehensive income is ultimately taken in the SOKI in terms of tab 3. And this amount in OCI is supposed to be R. This item is supposed to be R, that is called recycling. And this amount is going to be kept in the name of a column which is called cash flow hedge reserve. Like for example, when you revalue the asset under Ind AS 16, you put it in OCI and it goes to SOCI tab 3 under revaluation surplus. Similarly, when I'm going to capture this amount, I'm going to put this money in the tab number 3 under a column, and I'm going to call this as a cash flow hedge reserve. So this amount of cash flow hedge reserve is going to be treated later. How it is going to be treated later, we will see. So let me put this once again. I know it's slightly complicated, but hear me well. So I will calculate the fair value change of the hedged item, but I'm not supposed to account for it. So which means that if I was using a fair value hedge for inventory, I captured the fair value change of the inventory in the books. Yes. And if I applied a cash flow hedge, in this case, the fair value change of the inventory is not captured. And I would continue to record the inventory at the lower of cost or NRV. Exactly. So when I'm going to consider the impact in terms of a cash flow hedge, you are not supposed to capture the fair value change of the hedge item. It is only to be computed to be compared. Mind the words. It is only to be computed to be compared. So you're going to compare the fair value change of the hedged item and the hedging instrument. So if A is greater than or less equal to B, the entire amount, which is the fair value change of the hedging instrument, is going to be taken in OCI, that is in SOCI tab 3, cash flow hedge reserve. Next. If I say that A is less than B, then I will record the amount of B. I will again record the amount in B. I will again record the amount in B, but this time, out of this B, the amount which is equal to A, the amount which is equal to A will enter in the OCIR. And whatever is the excess, that is B minus A, whatever is the excess, that is B minus A, is going to be taken in the profit and loss account. So whatever is the amount which is this B, I'm again going to account for this B, but whatever is the amount to the extent of A will be entered in the OCI. And this is for the reason we say that it is the effective portion of the hedge. And the excess, which is B minus A, is indirectly called the ineffective portion of the hedge. And that's going to be taken in the P&L. Now you would say, sir, why is this happening? I could not understand that you are capturing, in this case, entire to the OCI. And you're saying there is effective portion OCI and there is ineffective portion which is taken in terms of P&L. I not get the logic. Let me explain this further. You see, at the end of the day, this is the item which you are trying to protect. And if this is the item which you're trying to protect, you entered into a derivative contract. So if you enter into a derivative contract and you are able to capture a more fair value change as compared to the hedged item, then I would say the rest of the hedge is not a cash flow hedge, but it should be treated like a normal derivative accounting. Because I am allowing you a hedge accounting that you should be able to cover this gain or this loss. So if you say that the fair value change out here is 10, and you're saying the fair value gain is, let's say, 10. Or let's put it the other way around. Let's say the fair value loss is 10. So let's say if you're saying that there is a fair value loss of 10 and here there is a fair value gain of 10, 12. So here you're getting a loss of 10 and here you're getting a gain of 12. You've already covered the loss of 10 and you've got another gain of 2. You're basically doing extra protection. And I would consider that in this particular case, you've already covered 10 and you got that excess of 2. That excess of 2 should be taken as a normal derivative accounting. So it is called ineffective. Now you would say, so why ineffective? I'm being effective in the sense that I have tried to get a gain from the hedging instruments more, but you have entered into a hedge which is over smart. I'll put it like this, that you've entered into a hedging and it is over smart on your part. And if it is over smart, we are not going to allow that over smartness. So we will say to the extent you covered the loss is effective, and to the extent you're getting that extra gain in life, that is the ineffective portion. So the standard setters decided that when a company enters into a cash flow hedge, you need to basically account for the fair value change of the hedging instrument. So the calculation of the fair value change of the hedge item is only done for comparison. I am not going to capture the fair value change of the hedged item. It is computed only to compare. So you're going to compare the amount of fair value change of the hedging instrument vis-a-vis the hedged item. If the amount of fair value change here is greater, everything is effective OCI. If the fair value change out here is greater, then to the extent of this amount, it is effective hedge and it enters the OCI. And to the extent there is an excess, that is considered ineffective portion and that enters in the P&L. Now, let me just quickly also give you a little comparative view at this stage so that we are yet to discuss the treatment of CFHR. We will take a practical example, but I think before that, I just need to give you one insight. So let's see a little comparative movement in terms of the fair value hedge and the cash flow hedge, so you can see the clear inputs in terms of the two. Because later on, there might be a little confusion in terms of what is being done in the two different hedge. So I think I'm going to give you a little input as well. Okay, Yadu, you said, so when should we use either a fair value or hedge accounting? Any conditions, please advise. Well, I'm not discussing that from the examination point of view, that, what are the, what kind of positions the company would take, because deciding the type of hedge in a practical life is going to be quite a complicated task. So I think I'll not get into that details. I'm already spending a good time so that you understand the hedge accounting practically. Though if you look in the study mat, there are no questions except one of the questions which came in RTP. But I thought I'll still, get into the discussions. Okay, now let's have a look in terms of that if a company uses a fair value hedge, then what happens? And if a company uses a cash flow hedge, then what happens? So let's look at a comparative position in this case, which will give me a short summary in terms of things. Now, on one hand, you've got a hedge item. And the other hand, you've got a hedging instrument. Let's put it as HI. Here also, on one hand, you've got a hedged item. And on the other hand, you've got a hedging instrument. So let's call it as HI. Now, what do you do in this particular case? Watch this carefully. I would say you calculate the fair value change and you calculate the fair value change. So we compute the fair value change in these cases. And do we capture the fair value change as well? The answer is yes. The answer is yes. You calculate a fair value change of the hedged item and the hedging instruments, and both are captured. And where is it captured? And where is it captured? So I would say in this case, it is captured in the P&L, but the exception. But in case of the exception, that is equity investments, it is captured in the OCI. Here also, it is captured in the P&L, but under the exception, it is captured in the OCI. So that is as simple as that. That is as simple as that. So I've given you the two things, compute, capture, and the third thing, where. So your mind needs to be very clear that in terms of a fair value hedge, what do you, whether you capture it or not. I capture the fair value changes of the hedged item and the hedging instruments both. So we compute them, we capture them, and the place where they're captured is taken. Now let's have a look in terms of this. Do you compute the fair value changes? Yes. Do you compute the fair value changes? Yes. That is common. The fair value changes are computed in a cash flow hedge as well. Now, if somebody says, I will capture this, no. I will capture this, yes. So if the answer is no, where are you capturing? I'm capturing nowhere. I'm capturing nowhere. I think this will give you a very clear-cut position. So in this case, you are capturing where? So we are saying, let's say this is A and let's say this is B. So we're saying where it is captured all depends upon if A is greater than equal to B, then you capture the amount in OCI. Then you capture the amount in OCI, you're capturing the amount in B in the OCI. And if you say that A is less than B, B is greater, then you say that I will capture in the OCI amount equal to A. In this case, you're capturing the amount equal to B. In this case, we'll capture in the OCI amount equal to A, and in the P&L, you'll capture the difference B minus A. I hope you got the entire position clear, which means also another implication which you need to understand. In this case, let's say, for example, if you're considering inventory, in this particular case, is the normal standard measurement principles getting override? Is the relevant standard applicable to the hedged item? Are we overriding the principles in this case? Yes. Like inventory would be taken in terms of what? Inventory is going to be captured in terms of fair value. In this case, is the relevant standard going to be applicable? The answer is yes, the relevant standard is applicable. You continue to apply the relevant standard on this item. And the reason is that it's a cash flow hedge. So if you're looking at an inventory for that matter, you've already purchased the item. So we don't need to capture the fair value change. Let the relevant standard on that item apply. So in this case, the relevant provisions of the standards will take a backseat, but in this case, the relevant provisions would apply. So you're basically capturing only, you can say, the fair value changes of the hedging instrument in this case, and depending upon it is effective or it is effective plus ineffective. So this is what we call the effective portion. And this is what we call the ineffective portion, which is captured in the P&L. Now, the only thing which remains is what do you do with that CFHR? I will now take an example, a comprehensive one, with the help of which I will give you the movements in terms of how that CFHR, which is OCIR, is going to be taken in the P&L and when is it going to be taken. I hope I am conceptually so far clear on the agenda. Okay. You're welcome, Yadu. You're welcome indeed. Now, I think let's take it further. Let me now give you a small question where I'm going to first take a very simple example just to quickly get the inputs, a basic example, just to see what portion is taken in the P&L, what portion is taken in the profit and loss. So let's take a very basic example just to understand, what difference is taken at which place. Then we'll take a little comprehensive example. So let's consider in this particular case that let's say I've got a hedged item. Let's say I've got a hedged item and let's say I've got a hedging instrument. So let's say I've got a hedged item and let's say I've got a hedging instrument in this particular case. So let's consider that the fair value changes which is computed. We compute the fair value change. Let's say the fair value change of the hedged item is 9,500, 9,100, and let's say this is 8,500. Now, in this particular case, we can say that the fair value change of the hedged item is greater. So what will you capture in this particular case? I would say I will record 8,500. I will record 8,500 in other comprehensive income. It is considered to be completely ineffective hedge. It is going to be considered completely ineffective hedge. I am not capturing this amount. I'm only capturing this amount, and that also in the OCI. Let's consider another case where you consider the fair value change. Let's say this is 9,100 and let's say this is to the extent of 10,000. Now let's see what is going to happen in this case. So we can see it's the other way around. I need to capture 10,000 itself. But out of this 10,000, the amount equal to 9,100. So I would say we will record 9,100 in the other comprehensive income, and the excess that is 900 will be recorded in the profit and loss account. So we're going to capture 10,000. But to the extent of 9,100, it goes in the OCI, and whatever is the difference, the excess is going to be taken in the P&L. So the accounting is being done for the hedging instrument. And you can see that in this case, we are working different. In a normal derivative accounting, you take the fair value changes in the P&L. In a fair value hedge, the derivative is again taken in the P&L with one exception. And in a cash flow hedge, you consider the portions in the OCI and the portions in the P&L. So see the comparative. When you're doing a normal derivative accounting, it is P&L. When you do a fair value hedge, it is P&L with the exception of OCI. And when it is a cash flow hedge, it is a P&L plus OCI. Effective portion in the OCI and the ineffective portion enters in the P&L. Interesting, isn't that so? Now, I think let's take an example with you where I am going to consider a comprehensive example illustrating you the entire accounting on different dates, including the treatment of the CFHR, the cash flow hedge reserve, which is going to get created. So let's begin with an interesting question to you. So let's take an example. This is a little comprehensive example on the concept of a cash flow hedge. And trust me, once you're going to look at this entire class in a go, you'll understand, I've done practicals so that you can get the entire grip in terms of things. I started my journey on the accounting of a derivative instrument on a standalone basis. Then I went to the accounting in terms of a fair value hedge, and then we're looking at the accounting in terms of a cash flow hedge. And trust me, with this, you will be able to capture the position and see the entire OCI. If I get time, I'm going to give you something very special towards the end of the class, which I'm sure I'm going to get some time. And I'm going to take you to very special inputs in terms of the discussion on SOKI, because I think with this financial instruments, this particular concept of financial instruments, you will be able to understand the entire concept of OCI, the tab 3, which is there in SOKI. I'm going to give you that. Let's take it further. If not today, if time doesn't permit, then I'm going to do that in the next class for sure. Okay, so let's give you an example and let's take a time scale. Let's consider the financial year again, January to December. So let's consider the financial year to be January and ending on 31st December. A lot of data which I'm going to give you. So watch this data carefully. Let's consider on 31st October X1. So this is X1 and this is also X1. So we are given, let's say on 31st October X1. So let's say on 31st, or let me just take a little more space. I need more data. So let me put it out here. Let's consider this to be 31st December X1. And let's consider this is 31st October X1. This is my balance sheet date. Okay, let's say I'm given on 31st October X1, the company has got inventory of gold. So let's say we've got inventory of gold. Let's call it just inventory. So let's say we've got inventory which is costing 6.4. So let's say this is costing 6.4 million. This is the cost. So this is the cost of the inventory, that is 6.4. It could be sold at 7.7. So we're given that if you sell, it could be sold. It could be sold, let's say at 7.7 million. This is, you can say, like the selling price of the item. Okay. And let's consider that to mitigate the risk, they're feeling that the value of this inventory might go down. So what they did, they entered onto the same date a futures contract. They entered into a futures contract on the same date, that is on 31st October. And the futures contract is entered where you are going to sell gold. You're going to sell gold. Let's put it, this is gold inventory for a safe side. So you're going to sell the gold, and I'm going to sell the gold, let's say at 7.7 million. So the company entered into the futures contract, and this contract will mature, let us say on 31st March X2. This is the date when the futures contract will mature. So that means it's going to be November, December, and this is going to be a period of 5 months when the contract will mature. So we enter the contract on 31st October and it's going to mature on 31st March. And now let's give you the status in terms of the balance sheet date. This inventory, the inventory fair value of this inventory, let's say the fair value of this inventory on the balance sheet date is become 8.6 million. Let's say it's become 8.6 million. And let's say the fair value of the futures went down. So the fair value of the futures decreased. It's a loss. The fair value of the futures decreased by 0.9 million. So this is the decrease in terms of the futures value. And we're also given further in this case that between these dates, there is no change. There is no change in the fair value of the inventory. And let's say there is no change in the fair value of the futures as well. So there is no change in terms of the fair value of the inventory, no change in the fair value of the futures as well. That's it. Now, we are given the further information that on 31st March, there are two things done. On 31st March, there are two things which are done. Number one, I sold inventory, and number two, I settled the futures. So I sold the inventory. This is one thing which I did. And I also settled the futures net of cash. I settled the futures, and this is settled in cash, not delivery, cash settled. So let's give you the data, and we're now going to look at this comprehensive question in terms of how the accounting would take place. So my financial year in this case is ending on 31st December. And on the 31st October X1, the company had inventory in the books, which is costing so-and-so. Expected that you can sell it at 7.7. The company is worried about the cash inflows arising from the sale of the inventory. So they enter into a cash flow hedge. And for this purpose, they entered into the futures contract to keep the cash inflows intact. So they sold the inventory at 7.7 to keep their cash flows intact. This is the fair value changes of the inventory and of the futures. And during this period of balance sheet date to 31st March, no changes. Finally, on the 31st March, I sold the inventory. And in this case, we also did a net settlement of the future. Let's now begin the journey. So first, I'm going to apply my 5-step model. So I'm going to first apply my 5-step model and then come to the accounting. Now, as usual, the first step is looking at a hedged item. So I put across a question to myself that what is the hedged item in this case? And undoubtedly, the hedged item is inventory. What I am trying to protect is supposed to be the inventory. And then I go to the step number 2. And in terms of the step number 2, we'll look at the hedging instrument. We'll look at the hedging instrument. And in terms of the hedging instrument, it is very clear that you are using a derivative contract, and which is supposed to be a futures contract in order to hedge. That is your hedging instrument. Then we go to the step number 3. And in terms of the step number 3, we're looking at the qualifying criteria. And when I look at the qualifying criteria, let's assume the qualifying criteria is met. It is an effective hedge, and let's assume all of the parameters, whatever. And then I go to the step number 4. And in terms of the step number 4, we will look into the type of hedge. Let's consider this as a cash flow hedge. The management wants to protect the cash inflows which you will get out of the sale of inventory. It's a cash flow hedge. Now comes the input in terms of accounting. So let's take you on to the accounting now. So we go to step number 5. And we're going to look at the accounting of this hedge. And I think to explain the accounting, I'm just considering a time scale. So we can see the accounting on different dates. On 1st October X1, when you entered the futures, then 31st December X1, which is the balance sheet date, and 31st March X2, when the futures is settled and the inventory is sold. So we've got 3 focus points, and the focus point is when you enter into a futures contract, this is one. When you entered into a futures contract, this is the balance sheet date. And we are also considering that this is the date when the inventory is sold. This is the date when the inventory is sold and the futures is settled. And the futures is settled. Okay, now I think let's have a look at each one of the movements step by step. So next 10 minutes, you're going to get a good hang in terms of the cash flow hedge as well. Now, let's go step by step. You know, I didn't say that earlier, but I think in the cash flow hedge, let me say that as well, which you already know. You know, if you look at a fair value of a derivative contract at the time when you enter the contract, that is the inception, it is always zero. Because if you do a squaring of a derivative contract on the day one, when you entered into the agreement, it is always going to be zero on that date. So no entries will be required in terms of any forward or a future contract. Now, hear me carefully. When I did the accounting in terms of options, I did an entry, there is option debit and a bank credit because there was a premium paid. But if you look at a forward contract or if you look at a futures contract, there is going to be no money paid at the inception, and the fair value of the futures or the forward contract at time zero is going to be zero. So no entries will be done at the inception in a forward or in a futures contract, but entry is certainly done in terms of options. I hope you got the position. Because in terms of options, you're making a payment of a premium, so you need to capture that. But in terms of forwards and futures, you need to capture the fair value of that contract, which at inception is always zero. So no entries in this case is going to be done on 31st October. Was it 31st October, right? Oh, I think I'm taking 1st October, so let's take it 31st October. So the day when you entered into the contract, there is no entries to be done. No entries are required to be done on this particular date when you enter the contract. Now, we are looking at a cash flow hedge accounting. So let's go step by step on this. Now watch this carefully. I am supposed to look at the fair value change of the hedged item. Mind you, I will compare this. I am not going to compare this. I'm not going to compare this. I'm going to compare this. 6.4 is the cost of the inventory in the books. You need to capture the fair value change when you enter the futures contract. The fair value of the inventory when you enter the contract was 7.7, and the fair value of the inventory on the balance sheet date is 8.6. So you capture the change of 7.7 and 8.6. There is a gain to the extent of 0.9. So we can see that on the balance sheet date, I look at the fair value change of the hedged item. And the fair value change of the hedged item is supposed to be 0.9, that is increase again. And let's look at now the hedging instrument. And I'm already given that the fair value of the futures has gone down by 0.9. So there is a loss on the hedging instrument, which is a perfect amount. The gain on the hedged item is exactly equal to the loss in terms of the hedging instrument. Well, that's a chance. So you know the principles that if this amount was below 0.9, then I would put entire amount in OCI. If this amount is more than 0.9, I'll put 0.9 in the OCI, and the excess is going to be taken in the P&L. But this time, the change in the fair value of the hedging instrument, the change in the fair value of this hedging instrument in this particular case is also 0.9, that is a decrease, a loss. A gain here and a loss there is a perfect hedge in this particular case. And I think now what we need to do, you've calculated the fair value change. What is the amount you are going to capture? So I'm going to capture this 0.9. I need to capture this 0.9. And where will I capture this? I will take it to the OCI. I'll take it to the OCI because in this particular case, this is the amount which is equal. The fair value change of the hedging instrument and the fair value change of the hedge item is equal. So you capture the fair value change of the hedging instrument, and this entire goes in OCI. So let's put a debit to the OCI. The entry done is OCI gets a debit, or you could basically call it as a cash flow hedge reserve, because OCI is not an account. So you're going to basically call it as a cash flow hedge reserve debit, and the corresponding credit could be given in terms of creating a derivative financial liability. So we could create a derivative financial liability correspondingly. So this loss is captured in the OCI, and we're going to put this entry to the extent of 0.9 million. That's it. That's all what is going to be done on the balance sheet date, capturing the fair value change of the hedging instrument. And we applied the parameters that this is completely an effective hedge in nature. Let's go to the next part now. So now we go on forward and we consider 31st March. Incidentally, I am given in the question that there has been no changes in the fair value between the balance sheet date and 31st March. If there has been no changes, I don't need to capture any changes in the fair value of the hedging instrument. Otherwise, trust me, I would have done a same exercise on 31st March as well. Technically speaking, we can say that this same exercise, we will do the same exercise at this stage itself. But since there has been no fair value changes in the hedged item and in the hedging instrument, nothing is to be captured. Otherwise, trust me, a similar kind of things is going to be done on 31st March as well. Now there are two things to be done. One is that you've sold inventory, that is one. And one is you've settled the derivatives, that is two. So let's do one thing. Let's see the entries first to sell the inventory. Now, you sold the inventories at what value? If there has been no change in the fair value of the inventory, that means this inventory even on this date is 8.6 million. And remember, what is the book value of the inventory in your books? It is not 7.7. It is 6.4. I never accounted for any fair value changes of the hedged item. So the inventory in the books of account is still contained at 6.4. So in this particular case, what do? You sell the inventory. So bank gets a debit or debtors gets a debit, depending it's a credit sale or a cash sale. And you will correspondingly recognize a sales revenue. And this entry will be at 8.6 million. So you put the entry that is bank debit or debtors and you recognize a revenue. Since you sold the inventory, you're also going to capture the cost of the inventory. So you're going to put another entry, and that is cost of sales gets a debit and the inventory is sold. So that needs to be given a credit in the books of accounts, and this is going to be at cost. So this is the selling price and this is the cost price of the inventory. It's a normal sale transaction recorded. This has got nothing to do in terms of hedge accounting. You just made a sale of the inventory and you recorded the cost of the goods sold, and these are the entries done. The inventory is sold, and now you got to put more entries as well. Now let me take it out here. So let's consider more entries, and now you need to settle the derivative, which is net settlement. Now if you're going to settle the derivative in this case, there is a derivative financial liability in the books. So if it is going to be cash settled, you got to pay this money of 0.9 million on the settlement of the liability. So your entry becomes financial liability, the derivative financial liability. So whatever is the derivative financial liability, that gets a debit and it is settled in cash. So the bank gets a credit, which is to the extent of 0.9 million. So this is the cash settlement of the derivative done. Now, what is left in the books of accounts? What is left in the books of accounts? What is left in the books of accounts is this CFHR. What is left in the books of accounts is the CFHR, which is accumulated in terms of TAP 3 SOKI. And it is now time that we reclassify this, we recycle this in the P&L. You entered into the cash flow hedge in terms of inventory, and the inventory is sold. And if the inventory is sold, in this particular case, now it's time that you transfer and recycle this amount in the P&L. So what we're going to do in this particular case, since the CFHR is a debit balance, you need to credit it. So the entry will be profit and loss debit. And the CFHR, the cash flow hedge reserve, is going to be given a credit, which is nothing but the OCI gets a credit. And this is to the extent of 0.9 million. So what we have done, we have recycled. We have recycled this amount in the P&L at the stage when the inventory is sold. So, but every time we're going to do a similar treatment? No, not every time we're going to see a similar treatment. Now, let me tell you something very crucial at this stage. So, hear me very carefully at this stage. So, let me put this to you very carefully and have a look at this stage. In this particular case, the hedging was entered with the perception that there was an inventory. So the moment the inventory is sold, we can say the hedged item enters the P&L. So the moment the hedged item enters the P&L, I transferred the CFHR balance in the P&L. Let's assume for a moment that in this particular hedge, you are, let's say, considering a machinery. If you're considering a machinery, for example, in this particular case, when you buy that particular machinery, is that machinery going to enter the P&L? No. So what is going to enter in the P&L? The depreciation on the machine. Hear me carefully. So if you enter into a cash flow hedge, which is, let's say, for the purchase of a machinery, and in this particular case, when you buy the machinery, the machine is bought, but it doesn't hit the P&L at that stage. It is going to hit the P&L when you go to consider depreciation over a period of time. And if you're going to consider a depreciation over a period of time, I will take the CFHR and adjust it in the machinery account. In this case, I will not put the entry P&L debit, but I'll put the entry machine debit to CFHR. And then the machine value changes, and you can say once you consider a depreciation, it indirectly enters the P&L. So it all depends upon the hedged item. In this case, the hedged item is sold, enters the P&L, so entire CFHR goes in the P&L. If this amount of hedged item is machinery, it doesn't enter the P&L, it enters in the form of depreciation later. So CFHR is going to be adjusted to the machine amount. And then later, automatically, the CFHR will get recycled in the P&L in the form of additional depreciation computed. I hope, friends, I made sense so far on that. Okay, and I think I've got a question from Satish. So when we made hedging, shall we need to make the collectibility assessment as per Ind AS 115 while sale of the hedge item for recognition of revenue? Well, I think in this particular case, the criteria in terms of Ind AS 115 will continue. When you're bringing the parameters of hedge accounting, you can say in this particular case, it is only the measurement principles of the standards which will get overridden. The other principles of the standards would not take a backseat. So if you're looking at, that what happens to the, the criteria in terms of collectibility, whether correction is probable or not, let me tell you, even when you, and that also when you enter into a fair value hedge, then only the measurement principles are taking a backseat, but other criteria of the standard would continue to apply. So it is only in case of fair value hedge that measurement principle takes a backseat. In terms of a cash flow hedge, you're going to still continue with the same principles, everything. Right? Okay, so that was interesting indeed. Now I think I've got some time and I am wanting to do a little inputs further to you to give you a huge clarity at this stage. My hedge accounting is done. I've covered the inspect of the cash flow hedge, the fair value hedge, the derivative accounting. Everything is taken done. I know it must have been very technical inputs, but nevertheless, I think if you see this in a chronological order, you're going to get a good hang in terms of things. Even if you're going to read what is given in the study material and you're going to see some charts in terms of hedge accounting, you'll be able to easily connect in terms of all what is given. Now, a little last area of discussion, the icing on the cake. And I think if this is not done, then I think my discussion is incomplete. Last few minutes in terms of a technical discussion, so please hear me very carefully. This will either clarify things or it might be a disaster. I'm taking risk and I think it's worth taking risk. Let's see. This is something because after the financial instrument standards is to a close, I think if this is not told to you, then I think my job is going to be incomplete. So this is the SOKI which I am creating. This is the SOKI which I am creating. And I like to consolidate the learnings from the SOKI connected to the financial instrument standards. Now watch this. So we're looking in terms of SOKI, and this is my tab number 1, and this is my tab number 2, and this is my tab number 3. And I think now we know everything because this is the standard which helps you to get the connect in terms of entire tabs. Now watch this carefully. As far as tab number 1 is concerned, it is equity component of CFI. As far as tab number 1 is concerned, it is equity component of compound financial instruments. As far as tab number 2 is concerned, it is reserve and surplus comprising of security premium, capital reserve, and typically the retained earnings. It is comprising of your security premium, your capital reserve, and typically your retained earnings. And if you look at the tab number 3, it is comprising of OCI. Whether it is NR or whether it is R, it is combined. Now let's begin the journey. In terms of the tab number 1 and then go to tab 3, or maybe you can start with tab number 3. Let's get the input. So please watch this carefully. Open up the Schedule 3 Division 2 SOKI in front of you if you can. I would have also shared that. Maybe we can do it in the next class. But if you can, just keep that Schedule 3 SOKI in front of you and hear this well. The OCI gets created on account of Ind AS 16 as well as Ind AS 38, and it creates a revaluation surplus. OCI came into account when the first time you did the concept of Ind AS 16 PPE and intangible assets 38, and it created an OCI revaluation surplus, which has got a no recycling concept. Then you went ahead, and in this particular standard, you got plethora. You've got a plethora of items, like when I did the concept of Ind AS 109. In terms of Ind AS 109, you've got equity investments, you've got debt investments, and you've got cash flow hedge reserve for that mine. So you've got equity investments, you've got debt investments, and you've got cash flow hedge reserve as well. This equity investments is no recycling. The debt investments is recycling, and the CFHR is also recycling. And you would also remember that in terms of another standard, there is Ind AS 21. You also get FCTR. So you've also covered Ind AS 21, and in terms of Ind AS 21, you create that FCTR, foreign currency translation reserve, and this is also supposed to be R. Oh my God. So you can see that the OCI gets created on account of 16, 21, and 109 with the combinations of NR and R, icing on the cake. And let me also remind you that you also covered something in terms of Ind AS 19, where there is an actuarial gain or there is an actuarial loss, and that is supposed to be OCI NR, and that is merged in tab number 2. This was the amount which is taken in the OCI, but it is merged in the retained earnings, or you can show it as a separate item in tab 2. This is the only exception. This is the only exception where the amount of OCI enters the tab number 2. And I'm not getting into the financial liability where the changes in the credit risk is taken to the OCI. I don't want to get into all that, but this is the basic. So Ind AS 16, 38, 109, 21, and Ind AS 19. Ind AS 19 is already a part of the RE column. Now watch this carefully. Now watch this carefully further. Can I say this amount enters the retained earning on the sale of the PPE? Directly, because it is NR. So when you sell the PPE or the intangible assets, it moves from tab number 3 to tab number 2. Wow. In terms of this equity investment also, it moves to the retained earnings on the sale directly. The accumulated amount here goes to tab 2 directly. The accumulated amount here goes to tab 2 directly. In terms of the debt investment, this amount, can I say, is taken in the P&L. So it goes indirectly. It goes indirectly to tab number 2. Because if you're going to put this in the P&L, if you're going to put this in the P&L, then it goes indirectly in retained earnings. Ultimately, it gets shifted to the tab number 2 indirectly by routing in the P&L, which you've already seen. In terms of CFHR, can I say this depends? In terms of CFHR, it depends. It might enter the P&L, like for example, inventory, or it might be added to the cost of the asset, like PPE. So this CFHR will enter the P&L or will be added to the cost of the asset, as the case might be. The FCTR is also supposed to be transferred directly in the profit and loss, indirectly in the P&L on the disposal of the investment. So when you dispose of the investment in a foreign subsidiary, then this also gets transferred indirectly in the P&L. So which means everything in the tab 3 directly or indirectly enters the tab number 2, except the case of the CFHR, where it might slowly enter the tab 2, but ultimately yes. So this is a temporary creation which ultimately one day will directly, indirectly enter the tab 2. I hope you got the picture now. So one of the OCI is already taken in tab 2 as a part of RE. Rest will directly, indirectly enter. NR will directly go and R will indirectly go. And now let's look at the equity component of the compound financial instrument. Trust me, this is the icing of the cake. You must look out the Schedule 3 SOKI and watch this, and you're going to see wonderfulness coming in. Now let's take it further and let's have a look further on this. Let's have a look further on this. Now, as far as the equity component of compound financial instrument is concerned, we discussed this in terms of Ind AS 32 when we are doing the discussions on compound financial instruments. And if you remember, I clearly gave you all the combinations that what happens to this equity component. Can I say it all dependent upon whether it is partially convertible, optionally convertible, and if you remember, I gave you that if the shares are given, it goes in the security premium. And if it is cash is given, the money goes in the capital reserve. So you can see at the end of the day that this is the main nadi, and these are the branches which are coming in. And ultimately what goes in tab 1 is a temporary parking, goes to tab 2, and this is all directly. This is all directly. It is never on an indirect basis. This is all directly. So what goes in tab number 1 one day goes to tab 2. What goes in tab 3 goes to tab 2 directly, indirectly. So tab 1 will one day finish temporary parking. Tab 3 will finish because it's a temporary parking. So at the end of the day, when the money is lying in the tab 1, it is not distributable as dividends. When the money is lying in the tab 3, it is not distributable as dividends. It is only when the money is lying in the retained earnings that is distributable as dividend. So the company reflects its other equity in the balance sheet of the company and tells us that, okay, this is the portion in tab 1, which one day will go to the tab 2. This is the portion of the tab 3, which will one day go to the tab 2 directly, indirectly. And this is what I have today to distribute dividends to the shareholders of the company. I hope, friends, this is quite useful indeed. And I hope I have triggered a lot of clarifications in your mind. You must map this up with the entire inputs in terms of Schedule 3. Look at the Schedule 3, all the columns, and see what are the items which are given in tab 3. And you will suddenly realize that yes, in the entire curriculum, you've only, OCI is been only touched in a few standards. The handful of them, 16 and 38, 109, Indus 21, and Indus 19. There are just 4 standards where the concept is touched upon. And majorly, if you notice, the concept of NR is only restricted to revaluations and equity investments. Rest is all a concept of recycling. So it is only 2 things which are going to be direct transfer to tab 2. Rest all is indirect. So even if you want to remember easily, you will say, okay, these are the 2, which is NR, which means rest is all supposed to be R, right? I hope that helps, and I hope that clarifies the agenda as well. And Satish tells me, wow, it's a wonderful summary of traveling movements of OCIR. I hope, friends, that helps. And I hope everybody, would have taken a note of this. This is something which is interesting, and this is something which I think you should know. Because if you're able to understand this bit, you have got the concept of Indian accounting standards, because this is the key. If you understand SOKI, you've started understanding the Indian accounting standards. Okay, so on that note, I think my hedge accounting is over, my derivative accounting is over, but financial instruments is not over. We've got another session, the last session on financial instruments, where I've got 2 agendas of discussions with you. One is I need to discuss the concept of impairment. And the other aspect I need to discuss is embedded derivative, which is again a bit little technical to understand, but I think we should be able to cover up that well. So in the last class, we will first start with the concept of impairment and then go to the embedded, or maybe the order can be changed, but these are the 2 agendas out here. Okay, so let's see if there are any questions coming so far on your mind, friends. So if there is any question, otherwise I think we're going to call it a day, heavy day indeed. Watch the portions on hedge accounting, do your revisions, and if the need be, watch this again, and you can get this. Right, friends, I think that seems to be all. Nothing more is coming further. So I think it's time, friends, to say goodbye to you. So I'm going to take leave from you on this end, and I'm going to see you on Tuesday. Tomorrow we don't have a class. I'm going to see you on Tuesday for the last leg in terms of financial instruments. Thank you very much, friends. Bye-bye and take care, and see you on Tuesday. Thank you.